Please welcome Susan Winkler, Vice President and Executive Director, CT Insurance and Financial Services.
Good morning, everyone, and thank you for being here. On behalf of the Connecticut Board of Directors, CTIFS Board of Directors, thank you for joining us today on the inaugural Insuring the Future event. So thank you again for being here. I would like to also thank our title sponsor, Cognizant, thank you very much, and all the sponsors who, without their support, we would not be able to put on this world-class insurance event today. So thank you to the sponsors. In 2022, we signed an international partnership with the UK to facilitate and foster insurtech business between the two countries. This agreement is recognized by the two countries as a way for participating US and UK insurtech companies to increase their knowledge of the markets, connect with business development opportunities, and make transatlantic connections to accelerate business growth. Today, we welcome 4 of those insurtech UK corridor companies who traveled to Hartford this week. I'd like to recognize them now. Insurance, Programmable, Pravisico, and Viper. Let's give them a really warm welcome from the insurance capital. And as a signatory and partner in the UK InsurTech corridor, I'd also like to recognize David Clay, His Majesty's Consul General to New England, who is here joining us today. Welcome to the other global center of insurance. And we thank him for his leadership and support of the InsurTech corridor. So we're here to talk about climate today. We all know about it. Weather perils, climate change, sustainability, resiliency. It is really the #1 risk for all of us. It touches all of us based on everything that's happened with fires and floods in the last couple years and last couple weeks. We know the numbers. We have about $10 billion of cat losses in 2023. That's the number. That basically it's a big number because there's not one single event that caused it, but multiple events. Frequency. Most recently, NOAA said the frequency is up. Their data shows an average of $20 billion weather events per year between 2019 and 2023. That's a 56% increase in frequency. And of course, I just told you about the cost. And then there's unpredictability. I cite the most recent example of the weather event we had in Connecticut a few weeks back. It was recently, Governor Lamont declared it a state of emergency approved by President Biden. Today, a donation will be made to the Red Cross on behalf of the CTIFS board and all of the speakers who are giving their time and energy today, and that will be directed to those 2 communities that were impacted by that historically significant weather event. Thank you, Red Cross, because the money will be donated to you to direct to those 2 communities. Lastly, thank you, Commissioner Mace and Commissioner Koski and the incredible team at the CID for calling about 8 months ago and saying, hey, in a true public-private partnership, let's bring this climate discussion to Hartford. So Alex and Anna and Mary and the entire team, we put this together to make sure this is a forefront issue on the insurance industry, and we're the insurance capital, the global leaders, the unity of that leadership is tackling that head on. So thanks again for joining us today. And with that, I'd like to introduce my partner who is always waving the flag for the insurance capital of the world, Commissioner Andrew Mace of the Department of Insurance.
Good morning, everybody. Thank you for being here on this lovely morning. In case you're wondering, yes, we did arrange this absolutely beautiful weather that you see outside, and we're looking forward to your coming back to Hartford to visit on your next vacation, and Susan can provide you all the details on that. But we do hope you enjoy Hartford. I am the Commissioner of the Connecticut Insurance Department, and the president of the National Association of Insurance Commissioners. And it truly is an honor to address you at this Insuring the Future event. As Susan mentioned, this gathering is a result of a new collaboration between the Connecticut Insurance Department and Connecticut Insurance and Financial Services. We've merged those two signature events, which is the Connecticut Conference on Climate Change and Insurance, which we refer to as C4I, and the Insurance Capital Summit to form this groundbreaking forum. Today, we will bring together regulators, government leaders, and industry experts to tackle some of the most pressing challenges of our time: climate risk, the role of technology, and how it is shaping the future of the insurance that we all need and that our society is based on. It is no coincidence that Connecticut is hosting this event. We are, and we've always been, the insurance capital of the world. Indeed, the insurance capital of the known universe, and I know nobody's going to contradict me on that one. But this title brings with it not just a rich history, but also a responsibility to lead in addressing the challenges that our industry and our society face, especially when it comes to climate change. We know, as Susan mentioned, as those of you who are from Connecticut know, but as I think all of us throughout not just the nation and the world, climate change is no longer a distant threat. It is a reality that affects so many aspects of our world, from the risks we undertake, the risks we underwrite, to the sustainability of our communities. In Connecticut, we recognize that insurance is more than just a financial product. It is a vital tool for managing risk, enabling resilience, and ensuring that communities can recover from the increasing frequency and severity of natural disasters and extreme weather events. But climate change is just one piece of the puzzle. Innovation and technology, we just heard about the US, the UK Hartford InsurTech corridor. Innovation and technology are driving change in how we assess risk, how we support policyholders, and very importantly, as our circumstances change, how we create new products to meet our emerging needs. These shifts are transforming our industry, and I'm happy to be able to say that Connecticut is at the forefront of this transformation, thanks to both the incredible staff at the Insurance Department, to people like Susan, with whom we form public-private partnerships, and to the industry that has been open to looking at new ways to address new challenges. We are all stakeholders in this great effort to preserve our state, our country, our economy in the face of climate change. We've seen the power of new technologies like parametric insurance and the rise of data analytics that help us understand climate risk in ways we never could before. We've worked closely with partners in industry to explore and to implement innovative solutions to the challenges we face. And if it's not implicit in what I've just said, let me make it explicit. To address these issues, we need collaboration. Collaboration across the public and private sectors, across government and industry, and across state, and indeed across national lines, to create a stronger, more resilient future. And that is why today's event is so important. It's a testament to the idea that the future of insurance and our collective ability to address the existential threat of climate risk relies on shared knowledge, on innovation, a willingness to adapt to new realities, and an unshakable commitment to minding the gap, closing that coverage gap that threatens families, communities, and our national economy. that end, we have an exceptional program lined up for you today, offering thought-provoking discussions at the crossroads, the intersection, if you will, of climate risk, innovation, and insurance. The sessions today will cover a number of crucial topics, including the impact of climate change on vulnerable communities and the urgent need for resilience. I don't think anybody who's read a newspaper or gone on social media or listened to the news on TV knows, I think everybody who's done that knows the challenges that are currently being faced, knows the difficulty in adapting to those challenges, and knows how important it is that we do adapt to those. We know, when we will discuss today, that how investing in community resilience can mitigate risk and stabilize insurance markets, and I use the word investment wisely. We know we get a significant return from our investment in mitigation activities, both in terms of direct help to those whose homes or businesses are saved from the most dramatic effects of climate change, and in terms of the rest of us who may not necessarily be directly impacted, but because we have put in place mitigation and resiliency measures, the total loss is reduced, which helps keep insurance, again, the insurance we all need, as affordable and available as possible. We all know, and we will discuss, the role of insurance in supporting risk-based mitigation and nature-based solution. And this is about ensuring the future. So we do need to discuss the importance of transition planning for insurers and consumers as we adapt to climate challenges. One of the secrets that's probably widely known is that climate change, along with everything else, brings with it financial risk to industry. And we need to address those risks, as industry has done, as we, as insurance regulators, have done, both individually across our states and collectively through the National Association of Insurance Commissioners, proving once again the strength of state insurance regulation. We must address, we are addressing, we will continue to address the increasing financial risks of climate change, both to the industry and to the country in general, and the insurance industry's vital role in promoting the greater good. So, yeah, we're going to save the world, or we're going to try. We're going to get a start on it today. So I just want to thank you for being here. I'll look forward to what I know will be valuable insights from today's discussions. And I look forward to us, and I say us, all stakeholders, working together to continue to lead, to innovate, and to secure the future. Thank you.
Really important that you be able to work together, especially as we confront climate change. I've recently been down in the Naugatuck Valley, Oxford and surrounding towns. The flooding, the devastation is just shocking. And then next door in Wallingford, Connecticut, had a hailstorm that took out a number of farms. I think the folks in the property and casualty insurance industry know all too well how these 100-year storms are becoming more and more severe and more frequent. So thank you for working together with our department, figure out how we can innovate to help us deal with this. We have a fair amount of resilience money coming from the federal government, dispersed by our Department of Energy and Environment. I think we ought to be able to work together to make those storms a little less severe, a little safer for our constituents. Thanks for what you're doing.
Thank you, Governor Lott. Good morning, everybody. My name is David Griggs. I'm the President and CEO of the Metro Hartford Alliance. Thank you for attending today's event. For those who are from out of town, I understand we've got a number of insurance commissioners from around our country. We even have international visitors. Thank you. Welcome to Hartford. We hope that you find today's event educational, rewarding, and energizing. And when it's over, we hope that you go out into our community and spend as much money as you can. For those who are local, I want to let you know that we are putting together a trade mission to support the InsurTech corridor. For this coming fall, we will be taking a contingent to London. If you're interested in attending with us, please reach out. Let us know that your company would like to join us. We'd love to have you. Again, back to our sponsors. Everything we do, be it from our investors on a day-to-day basis to today's event with the sponsorships. Thank you for what you do for our region. Thank you for what you do for our region. And this morning I have the privilege of introducing you to the Strategic Business Unit Leader for Insurance at our title sponsor today, Cognizant, Mr. Robin Kulasek-Araraj. Thank you.
Thank you, David. Good morning, everybody. Cognizant is honored to be the title sponsor of this wonderful inaugural event. We are fully committed to support the success of this, and we want this to be bigger and better every year. A little bit about Cognizant, because I think, this morning having coffee, a lot of you wanted to know what do we do, so a little bit of Cognizant. We are a US-based, NASDAQ-listed technology service provider. We are about $20 billion of revenue with about 370,000 employees partnered across 40 different countries across the globe. So we do everything under technology and operations, and the state and the city is special for our business. And especially in insurance, we are the largest service provider within the insurance sector, although we do support all sectors. So beyond that, why is insurance business and the state of Connecticut and the town of Hartford special? It is because our genesis of our insurance business started here 25 years ago. Today, we have close to about 5,000 employees who live and work out of the state, and most of them live predominantly in the Hartford County. So what started off as a handful of people 25 years ago has grown into a big unit. And of the 45,000 employees we have in North America, as I said, about more than 5,000 live and work and raise families here. So the state and the city is of special interest to us, and hence our partnership with MHA and CTIFS is really critical. And it is also special because our CEO in his past life also worked with the governor's office and the mayor's office to support all the economic activity of the state. So we have a little bit of, privilege we take internally to attract anything we can get to the state and the city. So hence, the state and the city are near and dear to our business. And behind the tech services we provide, it is really people and skill which come together to be able to successfully deliver engagements to our clients and partners. So we invest in talent, and we want to really invest in emerging talent, and hence we are partnered with a lot of the upcoming emerging talent initiatives. And our industry is disrupted by the advent of generative AI, and we have invested close to $1 billion to support our generative AI initiatives, both in terms of building out and partnering with insurance and insurtech ecosystem, but also investing in our talent. We're also sourcing talent through alternate channels, because we believe that there will be an injection of $1 trillion into the economy through our research, which means there will be a big gap of tech talent which will be required. So we have invested in programs, and we are partnered with some of the local community and also some of the liberal arts college here in the state. So lastly, it is also about giving back to the community. We firmly believe that that the ecosystem in which we work, requires the support for our community. So on that aspect, I am honored to introduce Kobe Langley from American Red Cross, who's also from an organization which is committed to, like us, to support and giving back to the community. Please welcome Kobe Langley from American Red Cross.
Thank you, Cognizant signature partner for this event. Thank you for Commissioner Nace for having me to speak with this amazing group. I was reminded not too long ago by the president of the International Federation of the Red Cross and Red Crescent in Geneva during a recent visit to New York of how important this collaboration is between humanitarian actors like the American Red Cross and our insurers, and how much more we can do together and that we should be focused on into the future. But I'm here to share with you all a cautionary tale. A cautionary tale of an organization, actually organizations, a collective of sorts, a group of independent entities that are operating under a common cause in an effort to help those who have experienced unimaginable loss and challenges. This group had access to all of the resources at their disposal of a collective, combined in collective brain power, access to different information and data, political influence that reached beyond their individual capacities, truly collective impact, the kind of access to foresight and strategic thinking and deep leadership that could help them see around corners and arguably even predict the future of their industry. But this group failed to fully see and appreciate the enormity of the challenges that their collective intelligence and wisdom was telling them. And they woke up one day with a realization that they were not in front of the global demands for their services, but were in fact behind. They were working under a collective business model that was not sustainable, not fully responsive, and was likely destined to collapse amongst its own weight of demands on their people and on their capabilities. What got in their way were individualistic aspirations, regional and geographic-based politics and priorities, and all too often an unwillingness to see any other way of doing things than what had worked in the past. Now, some of you may think that I'm talking about the collective that are insurers and insurance regulators of our great country around the globe, but I'm not. The industry I'm referring to is a humanitarian network of our Red Cross and Red Crescent societies around the world, and of course here at home in the American Red Cross. This collective group of humanitarian actors woke up one day and recognized their own challenges and their own opportunities that had been missed because of their lack of will and lack of political action. They looked at the workforce, the data, community presence. We looked at the data showing us our requests from our local branches to assist in recovery from wildfires, from storm surges, from flooding, and from heat waves. Does it sound familiar? Here's what we found. The United States has seen more reported climate disasters over the past 2 decades than any other country. In the last 10 years alone, more than 900 disaster events have displaced nearly 8 million people in the United States. The United States had the most highly destructive hurricane landfalls over the past 5 years than the past 53 years combined. Similarly, 3 of the top 5 years for acreage burned and the most destructive wildfires in the United States occurred in this decade. The increase in climate-fueled extreme weather is not limited to a few locations on the coast or even near wildfire-prone areas. The data that we've been able to collect over 100 years in responding to these disasters have told us this is a reality. In 2021, more than 40% of Americans lived in local counties that were hit by climate disasters, and more than 80% experienced a significant heat wave. This relentless disaster tempo has brought our organization to the very edge of our capacity to help those that are most in need and to help them withstand future disasters and related displacement. By 2030, we anticipate that the Red Cross network around the globe will be responding nearly continuously to concurrent major disasters driven by extreme weather. Your reality for the people in this room, you've seen the skyrocketing costs of flood and wind damage claims, death and injury claims. It's a hockey stick curve, and it's happening in the Americas in our own backyard, not somewhere across the globe in a rainforest. Over the past decade, 83% of all disasters worldwide were extreme weather and climate-related events, 83%. such as floods, storms, and heat waves, and they impacted billions of people. And let's not forget wildfires. While 2023 saw a milder season overall, the Lahaina wildfire in Maui Islands is a stark reminder to all of us of the devastation that can be caused by these events. A single fire that caused $3.5 billion in insured losses, highlighting the dangers of wildfires around the country, even in unexpected locations. This trend of increasing catastrophic losses has serious implications for the property insurance industry as well as for humanitarian responders. Rising costs. Insurers need to pay out more claims, leading to higher premiums. Reduced availability. In high-risk areas, insurers have to become more reluctant to offer coverage at all, leaving some homeowners vulnerable. Strained resources. Catastrophic losses can strain insurers' financial resources, potentially impacting their ability to pay claims properly. All of this leads to an increased humanitarian suffering. And it's an unequal burden. The weight of climate change doesn't fall evenly. Imagine living on the streets in America, exposed to the elements 24/7. Now, imagine those elements becoming more extreme. That's the reality for many of the most vulnerable amongst us, the homeless. Extreme heat events, as I mentioned, are on the rise, and people that are experiencing homelessness are more susceptible to heat stroke. Makes sense. In California, we show a disturbing trend of 13% of all heat-related hospitalizations from 2017 to 2021 were among the homeless population. Migration. Climate change forces people to move, straining resources in safer areas. Here's the reality. We can't ignore this crisis, but we do need, as the Commissioner mentioned, a multi-pronged approach. It's going to take all of us, not just the insurance industry, not just the regulators, but humanitarian actors and nonprofits and our local community leaders. Broader strategies that we've adopted globally offer us a roadmap. Climate adaptation leaders like our Red Cross and Red Crescent societies around the globe, where do these humanitarian organizations that are at the tip of the spear of responding relentlessly to these climate-related disasters, where do they see the opportunities? The vast majority of 192 countries around the world that have Red Cross and Red Crescent societies have signed on to a climate resolution in Geneva in 2020, and amongst themselves have committed to investing in 3 focus areas that have the potential to deliver transformative adaptation to our most vulnerable communities. We're not the only nonprofit organization that's named in these events, and municipal emergency disaster plans play a critical and important role. The American Red Cross, as the only nonprofit that's named in most national disaster plans, is also named in most municipal and state plans as well. One of our jobs, as well as other Red Cross societies, is to provide shelter and feeding and immediate assistance after disaster. We are your partners in ways that you likely don't realize, and we're working in the same ways to reduce harm and suffering. And some of the areas where the American Red Cross and other national societies are seeing progress in prevention of loss: early warning and anticipatory action, safety nets and shock responsive social protections, and yes, even nature-based solutions. Hopefully, our organizations can work together to identify the most vulnerable populations, to share information and data. Working with insurance agencies who are willing to share their data with informed consent can help expedite this process, identifying and targeting the most vulnerable communities, leveraging our collective knowledge for the greater good. Adapting and creating new programs to complement national efforts or to channel assistance with few delays. National societies in a lot of countries are working to make social protection systems shock responsive. They help governments use social protection databases and even payment channels for anticipatory cash transfers as an early action, providing cash assistance to communities' needs before the disaster hits. Some insurers around the globe are exploring pre-disaster payment options for communities in high probability zones to help them buy what they need to evacuate or to survive in place just in time for an immediate disaster. Insurers can explore community partnerships with municipalities in high vulnerable communities to help improve early warning systems, connecting with community preparedness initiatives, and increasing the use of forecast information and social protection systems. promoting coordination between different interstate agencies that otherwise don't interact, as is often the case between emergency response agencies and social welfare or long-term resilience building actors. And nature-based solutions for other preventative measures like simple education or even fire mitigation and home fire risks. There are many opportunities for us to provide an increasing impact and support for the people that we serve. And whether you believe in climate change or not, the reality of these billion-dollar climate-related disasters is at our doorsteps and will continue to present nearly insurmountable challenges. I would remind everybody here today that our collective action can and will make a difference, but it does require us to look inward, to consider the mistakes of the past, to be willing to accept the realities of today, and to establish a greater future for our children and our children's children. Lastly, I'd like to remind the audience here today that the American Red Cross is one of many nonprofit organizations that cares about alleviating human suffering in our communities. And sometimes even small acts of a humanitarian intervention can have broad impacts over the long term. One of these small acts the American Red Cross invested in nearly 10 years ago was a simple act of knocking on a neighbor's door, asking if they had a smoke alarm, and then asking if they could have permission to come into the home, to sit down with the homeowner, to talk to them about the dangers of fires, help them with an evacuation plan, and then, yes, install a new free smoke detector. 3 million smoke detectors later, and 2,000 lives saved later, the American Red Cross continues this very simple community-based intervention and act that reduces harm, reduces casualties, improves resiliency in communities, and yes, saves lives. That's what we're here to do for you, for our community, and we'll continue to commit to now and into the future. Thank you for the opportunity to talk to you about our challenges and the opportunities for a brighter day ahead. Thank you. I have a special video to share with you.
So the smoke alarms went off and everybody automatically ran downstairs. There was black soot smoke inside the home, but we didn't see any fire, so we thought it was a Christmas tree. My grandson was standing over here and he opened the garage door, and that's what it was. The flames were already high. My husband, he jumps over to the door and he said, "Everybody get out, get out." And so we all just, left out through the front door. After that, we ran across the street. We called the fire department. We had all the neighbors was out. They was helping us with whatever we need, but everybody was calling 911. They was making sure everybody was okay. So he went and opened that door, and by the time he opened the door and my husband stepped over, he was like, "Everybody get out." Same Red Cross that came out, that was at the event, was the same ones came out that night. They still called me the next day, checked up on me, make sure if I needed anything to just inform them and let them know. So they did keep in contact with me.
Well, we always encourage people to get smoke alarms because they do save lives.
I would tell people to make sure they're prepared for their fires by checking their smoke alarms. And also, you got to have a fire plan, and everybody needs to know exactly their escape routes. I want to tell Red Cross, thank you. Thank you for showing up, because like I said, I didn't know what I was going to do that night. But, they came out, they gave me a hug and everything and told me it's going to be okay. And they took me on to the next step. So those smoke alarms really helped me. It saved my family. It saved our lives.
So as also get pushed out to the stage to say, hey, you need to fill time. So, what do you want to talk about? So I will introduce panel one in just a moment. What I guess I wanted to, I've been thinking already, what am I going to say, what am I going to do? But what I would like to know is from a show of hands here, we've talked about a little bit about a climate in that most of us are kind of not really prepared for floods and maybe even fire. I think we all have smoke detectors in our homes. That's kind of a natural thing to do. But as representative for the insurance industry, you know, I'm looking to see what can we do on the education side. You know, we're the young people. I spoke with Commissioner Mace. I don't know where you are right now, but this morning, and you talked a little bit about the next gen, not even really understanding what a deductible is and a premium is, and certainly not understanding the value of insurance on their homeowners. They all insure their phones, so they all have insurance on their phones. God forbid, right? Something happens. But from a rental standpoint, from their possessions, and then homeowners and auto, not so much excited about that. So from a standpoint, I'm looking for what I consider a more seasoned audience. By a show of hands, because this goes back to the conversation I had earlier, how many people have in their home some kind of device, not a smoke detector, that alerts them of flood or fire or a significant problem with an appliance or something? Raise hand because I can't see. All right, so I'd say 50% because you're all from the insurance industry. All right, so that being said, how many of your friends, family members, let's start there, would have those same devices? Show of hands. A little higher. All right, how many? That's significantly lower. And then secondly, how about your children? Would they have renter's insurance? Would they? How many of your children have phone insurance? All right, so because you can't see what I see, I saw an incredible amount of people here in this audience that are already doing the preventative measures that it's needed to protect themselves, because you're all insurers and you work in the industry or you support it. But the next friends and family, it looked like 35% of you said your friends and family have some kind of protection measures in place. And then for those younger generation, nothing, very, very small. So when we talk about what we have to do going forward in climate risk, yes, we have to assess the risk differently. Yes, we have to build technology tools that help us do that and help mitigate, build sustainability and resiliency, but there's definitely an education factor. That's the only thing I'll say, because I don't know where that lands. Commissioner Mace talked earlier about putting into the financial literacy programs, make sure they understand the value of insurance when they're learning about financial wealth and retirement. But anyway, that's food for thought. So I've talked enough. I'm not sure how much longer I have, but are we ready for the panel? Keep going? Honestly, you can't make this up. I'm out. So, but that was important. Thank you very much. Any questions? Anything you want, I don't know, to talk about? Okay, I know what I'm going to do. Could I get a representation? We have a lot of out-of-state regulators here. The importance of this event is the fact that, as you learned, we've merged two very significant events. One was the Climate Forum, hosted each year virtually by the Department of Insurance, and the Insurance Capital Summit, which ran for about 14 years here in Hartford as well. So we merged the two, but with Commissioner Mace being the head of the NAIC, we invited the regulators. So it's very important that we recognize the states that are here today in our fine state, in our fine city, to say welcome. So I know South Carolina, can you raise your hand? I know you're here somewhere. Over here? Okay, thank you. Want to stand up? Thank you, Commissioner, for being here. I met somebody from New Hampshire. Could you please stand up? Thank you for being here. Vermont. I don't see you. Thank you very much. He was kind enough to walk me to my car yesterday. Thank you very much. California, please stand. Thank you very much. I think we've got taken the furthest trip here. Let's see. Who else did I meet? Missouri. Thank you. Over here. Okay, we're done. Okay. Well, but now, DC, I do want to recognize the commissioners. I think it's very exciting. Thank you very much for being here. Commissioner, who did I miss? Oklahoma. Nice, Midwestern state. Iowa's not here, are they? Puerto Rico. Where are you? Nice. Welcome. Okay. I'm okay. Wait, I want to make sure I don't miss anyone. Arizona, I met last night. Arizona, where are you? This is exciting. I should have done this and built this into the repertoire anyway. Maine. Where are you? And Alabama. I met Mr. Alabama. Where are you? Okay. Nebraska, of course. Thank you very much for being here. Anybody else? Ohio is here? Ohio, you may stand up, even though we're competing for jobs all the time. Thank you for being here, Ohio. Did I forget anybody else? Okay, I've done my job. Thank you again for being here. Panel 1, please proceed in. Introducing the critical role of community resilience and climate adaptation.
Well, thank you. It's a pleasure being here in Connecticut. This is my first time in Hartford. Thank you, Andy Mays, for the weather. I came from Montgomery, Alabama, where we're having a cold snap right now. It's probably going to be 89 degrees today. I understand it's going to get warm again, then cold again, then warm again, then cold again, and then I think it'll get cool, and we may get down to where we have a high of somewhere in the 50s or 60s or something like that. Who knows? But anyway, it's a pleasure being here with you today. We're talking about a number of things that are very important to all of us. We're talking about resilience, mitigation, climate change, and insurance. Now, we all know what those mean generally. We think we know what they mean, but they're words that have not really been used together like they are today, and only really in the last decade or two have we been talking about them in sort of the way we've been talking about them lately. They're almost becoming national buzzwords the way they're being talked about. We're having this great conference here, and there are conferences all over the country are taking place talking about resilience, mitigation, climate change, and insurance. We've been talking about them in Alabama for the last couple of decades, and it's because we found ourselves with two major hurricanes, Ivan and Katrina. In fact, let's think about Louisiana right now. Right now we have Tropical Storm Francine right off the coast of Texas. Later today we're going to have Hurricane Francine, and it's going to be going right through the heart of Louisiana, probably tomorrow. And in Mississippi, and I think my state of Alabama is going to get some of it as well. I'm supposed to be flying home tomorrow. That should be great fun. So we've been talking about this for quite a long time. You know, after Hurricane Katrina and Hurricane Ivan, Hurricane Katrina hit a good part of Alabama as well. Hurricane Ivan had us in the sights. things were going crazy in our state. The market was going crazy. Insurance rates were going crazy. Legislators were going crazy. They were trying to legislate rates, and it was kind of insane. So even before he was Insurance Commissioner Jim Ridling, my predecessor, he was former insurance executive Jim Ridling, living in Montgomery, Alabama, retired, and then Governor Bob Riley asked him to go down to the coast and sort of be a mediator, sort of calm the waves. He said, "Are you crazy? You're going to send me into that buzzsaw." Well, he did. He got down there and worked with industry, with academia, with locals, governments, with consumers, and in all that was going on down there, it was really insane. The legislators were going to legislate rates, and Jim Ridling said, "Hold it, time out, folks. Time out." He said, "You're not going to do anything about insurance. You're not going to do anything about rates until you change the economics of what happens after the storm hits. Build stronger. Have less damage. And the domino effect of that is what's going to change the world." That started it all off in Alabama for us. A couple of years later, he became Commissioner Jim Ridling. And he pulled Charlie Angel in as Deputy Commissioner and Chief Actuary out of industry to start a mitigation program and a granting program where we would help Alabamians build stronger and live safer. They called it the Strengthen Alabama Homes. He pulled Brian Powell here out of obscurity in the receivership division of our department. I'm not sure what Brian was doing up there in receivership in our department, but we pulled him out, and he used his former military experience and project manager experience to take this program on. And we partnered with academia, and we partnered with consumers, we partnered with industry, and we partnered with whoever would come aboard. Nonprofits, Habitat for Humanity is one of the ones we work with quite a bit. And this program was born. Fast forward to today, we've spent a little over $74 million. We've mitigated a little about 7,500 homes. We're in 40 counties of the 67 Alabama counties. We haven't made it all the way to the northern part of the state yet. In Alabama, we're about to celebrate, I think maybe Monday, we're going to join IBHS and Smart Home America, and we're going to celebrate 50,000 fortified designations in our state. And we've become the most mitigated, most resilient state in the nation. And that was our goal in that. And it all started with Jim Ridling, before he was commissioner, saying, "You're not going to do anything about the market, insurance, rates, or any of this until you change the economics of what happens after the storm hits." A lot of things happening today. No matter what you think about climate change, how you look at it, how you see it, it is an absolute fact that the frequency and intensity of climate-related events and weather emergencies and devastating events are increasing. The east, the winds are blowing in the east. Somebody told me the other day, the winds are blowing in the east and the fires are burning in the west. We have to talk about these words together: resilience, mitigation, climate change, and insurance. And we have to know how they work together. And we have to know how we can work together to address them. So we're going to talk a lot about them today. We're going to talk about them here on our panel. I'm very honored to be here at this program and have these amazing panelists with me today. Let me introduce who's here. We have Fred Malik, who's the Managing Director of Fortified at the Insurance Institute for Business and Home Safety, IBHS. Now, IBHS operates a world-class research facility in South Carolina, one of the largest wind tunnels in the world. Jim Ridling, my predecessor, used to call them the crash test dummy people for building and home construction. So that's what we have at IBHS. Leslie Chapman Henderson. Leslie is President and CEO of the Federal Alliance for Safe Homes. Now, folks, that spells out Flash. Now, I'm an old DC comic fan. That's not the Flash. But I'm not so sure that Leslie Chapman Henderson does not actually have superpowers. So Leslie's here with us. Brian Powell is here. Brian, until just a few months ago, ran our Office of Risk and Resilience, and I had the pleasure as commissioner of appointing him director of our newly created Office of Risk and Resilience. That's where we house Strengthen Alabama Homes. For many years, he was the first director, sort of the founding director of Strengthen Alabama Homes in our state. Brian Powell has experienced the pain and the pleasure of creating something new and innovative and seeing it through the challenges we've seen about it. Those states, we are so thrilled that so many states are modeling that program in their own states. We've made all your mistakes for you. We've figured out all the things that we had to do, and Brian saw us through all of those things, and to create that program. And he's helped us work through those challenges and helped us create that program and manage that program. And then as soon as I put him in as Director of Office of Risk and Resiliency, up and left me for NAIC. So I've not forgiven him yet. So we haven't actually spoken today. No, I'm just kidding. Jerry Theodoro is the Director of Finance and Insurance and Trade Programs at R Street. Jerry, I may just have to do like recently when you were testifying in the Senate, Senator Kennedy from Louisiana did. I'm not sure my southern mouth is going to get around Theodoro very well. So I'm just going to call you Jerry, if that's okay. So thank you, folks, for being on this panel today. Let's talk about those issues. Let's talk about resilience, mitigation, climate change, and insurance, and how we can work through some of those issues. And I think we're going to have some questions through Slido on here. Y'all pray for me that I'm going to be able to get through this. I'm really just a radio DJ and a banjo player at heart. I'm not sure I can handle this technology. I asked for an 8th grader to help me with it, and they've not given me that yet. So here we go. One of our questions we want to address in here, and I'm going to address this first to Leslie and then to Fred, is how can investments in community resilience specifically reduce the risk associated with climate change for insurers and policymakers? Let's start with Leslie on that one.
So first I want to say that the last time I was here, and it was a very long time ago, it was 6 degrees when I arrived. So I haven't been here in a while. That might be part of it, but after this morning, I'll be back in soon. So thank you for the beautiful weather, Commissioner. So I want to kind of give you some backdrop on how we connect to this, because our organization was specifically organized 26 years ago to focus on disaster resilience. We didn't actually have the cool word 26 years ago, Commissioner. We called it mitigation. Everyone was very excited about it. Just kidding. But early on, we were very fortunate because our partners of the future in the climate resilience space came forward and said, you know what? We want the same things. We have a slightly different focus, but the solutions that are at the core of how we advance resilience are really the same things. So you did not know this, but today you're meeting your cousins, because we are the resilience cousins, climate and disaster, and we go together, okay? So what's it all about for us? Just as you said, and I had a 12-year stint in the insurance industry prior to my 26 years in this role, where I had the opportunity to see on the ground post-disaster why we needed to do things differently. And how we connected to it, and when we look at it together, it's about breaking the cycle. We have a cycle. Unfortunately, it persists, but gatherings like this and the leadership of the insurance commissioners of the U.S., the partnerships with NAIC and others, are driving change. Just looking at the turnout here today and the frequency of this conversation. But how do we break the cycle where we build, Mother Nature destroys, and we rebuild, but do we do it differently? So that's always been the call to arms for us. And as far as how communities can make a difference, it all boils down in our ideas to 3 things. And there are additional solutions, and we're going to talk about that, but we can't skip over how we build. There's 3 places we get to resilience as an end game. One is building it right the first time with that climate risk and disaster risk in mind. The second is fixing up the old stuff that was built before we had our modern model building codes with all those insights that our engineering and science partners come forward with after the disaster, and we see those trend lines. In 1992, after Hurricane Andrew, we knew gable ends needed to be braced, so that went into the building code. And so it's a continuous process of improving the code based on what we learn. But the third is the culture of resilience. Creating a marketplace, as you've done in Alabama, where you have 66+ hundred grants that went out, but you're celebrating 50,000 homes that are fortified. So the lion's share of those homes were fortified by the private sector because people started looking around and saying, hey, what's this all about? So in our work, when we look at resilience as a challenge and as an an effort to make a permanent change, we said, what does a disaster resilient leadership profile look like? And of course, we look to the insurance, regulatory, the commissioners, and the directors across the country because you are the de facto risk managers for your state. You are propping up, in partnership with the insurance industry, the economies of your states, and you make all things possible, and when things are disrupted is when it gets really tricky. So we partnered with NEIC, and I want to invite you guys to pick one of these up. This year we published this playbook, and it really takes you through, and Brian is going to talk more about fixing up the old stuff through the grant programs, but you've got resources in here to guide you into these 3 paths to resilience. And as we work hand in glove with our partners in the climate resilience, we're merging because those solutions are the same. I just want to briefly mention on the building code front, our partners at the Code Council and other code development organizations are the silent defenders. And the building code conversation has, in the past, been a difficult one. In fact, I remember in 2011, after the Joplin outbreak, we talked to Reuters about the building codes and how we can build to withstand most tornadoes, which is a very novel idea at the time, coming out of the great work of a series of our academic partners. And I was a little elbowed by some of my partners that said, it's a little early to be saying that. How can you say that right now? Because we're in response and recovery. Fast forward to 2020, 2018, 2019, 2020, we not only talk to the press about the building code, but we get the call a week in advance. The hurricane's coming to Southwest Florida, as Ian did. USA Today will call and say, how's it going to go down there? We look at the codes. We have the tools, the analytics, and the ability now to predict how well it will or will not go. And that's where the insurance industry comes in to also align those codes that are in place and reward them. That's where FEMA has stepped in the past 5 years, which you'll see in this guide, the tools, the studies, the information, and all the assets that our leaders have told us that they needed. So I think that from my perspective after, oh my goodness, admitting this, 38 years, I'm so encouraged and I'm so excited about the direction because what's been missing, we know how to build. One of my favorite quotes is from Dr. David Pravat at University of Florida Engineering. He said, you know, if we can put a man on the moon, we can keep a roof on a house, right? And we know how. So what's the problem? We just have to do it. But the change making that's in place and the acceleration you'll hear about in the Fixing Up the Old Stuff programs is the leadership of our insurance commissioners and that community that's making these linkages and hosting events like this. Whether it's the passage of DRRA in 2018, and Natalie Enclave from BuildStrong's here, she's going to talk about, we gathered after we got those federal dollars to come forward on the pre-disaster basis, which is a critical part of this. The big question is what's next? And so we were a cause and a need seeking partnerships, and the insurance community coming together to drive building codes and to create awareness. And building codes have to rise up in the esteem of the public so they understand it's a delivery system for everything they need to meet this resilience challenge.
Fred?
That's a hard act to follow there, I tell you. So,
Glad I'm calling on you.
My name is Fred Malik. I'm the Managing Director of the Fortified Building Programs at the Insurance Institute for Business and Home Safety. And as a fellow Southerner, my panel here, we're all from the South. We enjoy this weather immensely. So thank you from me as well. I'm coming up from South Florida. I'm a builder by trade. I did not come from the insurance industry. I'm not a public policy person. I build houses. And I come from a group that historically is reluctant to change. You really got to prove it to us that something needs to be done because it directly impacts the affordability and our ability to sell homes. But over the past 16 years of running the program, I have been converted. So you will hear me and see me out on the soapbox out there because builders play a pivotal role in shepherding that change that Leslie talked about. I think that Leslie also made a very important comment that in order to be resilient, in order to face the demands that are coming from climate change and changing weather, it does take a culture of commitment. You cannot affect change passively and just expect it to happen. You're going to have leaders and local stakeholders who drive that change and invest in making the change. The science is very clear that, and that's what we do at IBHS, is we look at the built environment, we can test buildings at an unparalleled scale, but we also look at the meteorological elements of weather, because we have to anticipate what's going on to happen. The science is very clear. The environment is getting wetter. That's leading to things like rapid intensification for tropical cyclones. It is shifting and widening the area where tornadoes and severe wind events like derechos can occur. And we are seeing a gain in northern latitude for tropical cyclones. So places like Connecticut and New England need to be thinking, this is coming our way. We have to get prepared now, because 10 years from now, it's going to be too late. You're going to have an awful lot more inventory that's built in a more fragile state. Something as simple as sealing the roof deck, which I'm going to set up an example of that out in the lobby for you all to circle by and take a look at that. But something as simple as that can make a really significant difference in the community's risk profile. And when it comes to insurance, I mean, that's really what we have to do as builders and consumers, is we have to make ourselves better risks to insure. The absence of improving our properties as risks is going to mean higher premiums to cover the risk. And if we want lower premiums and greater availability, we have to mitigate, we have to become more resilient. The last thing I'll say about making investments, I think the commissioner here and the leadership that Alabama showed in following the science, he said, what can we do to stimulate that change? And as Leslie mentioned, they've invested tens of millions of dollars to fortify thousands of homes, but that's only a small percentage of the homes that are actually fortified. And so that stimulus creates an opportunity to train the workforce. It creates an opportunity to talk about what change is possible. And that is ultimately what begins to be the engine that drives change. And then other things like code considerations and recruiting the workforce can come along with that. So the last thing I'll say about that is that the very smart thing that the commissioner did in the state of Alabama, places like North Carolina, Mississippi, Louisiana, Oklahoma, they focus on the roof. And when it comes to residential and commercial structures, the most vulnerable system on the building is the roof. If you make sure that roof is going to stay intact, keep water and wind out, you're going to drive losses down.
I used to hear Charlie Angel say it all the time: if you lose your roof, you lose your home.
That's right.
If you lose your roof, it becomes a water bucket. You're going to lose your home. So, Jerry, what are some of the examples of successful community resilience projects and how they impacted the insurance markets in those states? Can you help us with that?
Yes, thanks for the question, and it's a personal pleasure for me to be back at the building. The last time I was here, I was standing right about here in the bass section of the Hartford Chorale, Hartford Symphony Orchestra right there, so it's great to be back. The Strength in Alabama Homes was really the forerunner of other successful programs. The numbers are that an Alabama home that's fortified sells for 7% more than one that's not fortified. So those are real numbers. And the program was sort of exported by Louisiana. And in Florida, as Leslie knows very well, there's the My Safe Home Florida program, which has been renewed. So there's other examples that followed on the great work initiated in Alabama. And Commissioner mentioned Hurricane Katrina, 2005. A good case study is to compare the aftermath of Hurricane Katrina to Hurricane Ida, which 16 years to the day after Katrina struck Port Fourchon in Louisiana. And so what are the differences? Well, we all know Hurricane Katrina, about 1,800 people were killed in this Category 3 storm in New Orleans. The levees were broken, and after that, lessons were learned, and New Orleans went about strengthening the levees, building back better, building back stronger. So we were all watching about 3 years ago with Ida, will the levees hold? And they did, because of the investment that was made in the barriers, the water barriers, and the levees, and the dams. So it really was effective. This was 2021, 3 years ago. So this is holding, and that's a good example. And if we think further afield, we talked this morning about international collaboration, cooperation. We have folks here from the UK. And I think of the Netherlands, which is one of the low countries. Most of the Netherlands is under the sea level, below sea level, and for centuries, the Dutch have had severe flooding occasions. 1953 is really when it came to a head, when there was an incredibly powerful storm, 1953, that took about 2,000 lives of Dutch folks. The barriers were broken in almost 100 areas. And so the Dutch sat down and they planned to really strengthen the defenses. And the politicians were aligned. The House, the Senate in Holland, Queen Juliana signed it into law. And for several years after that, the strengthening of the measures resulted in Holland not having one of those storms for over half a century. So that worked, saving tens of billions of dollars. And so we have those examples, I think, are good case studies that we can think of. Alabama leading to other states adopting similar fortified required programs, and Katrina versus Ida, and the 1953 learning from the Dutch.
Thank you, Jerry. Brian Powell, let me ask you this one. What role do public-private partnerships play in enhancing community resilience, and how can insurers collaborate with local governments and organizations in these efforts? I think back at Strengthen Alabama Homes, we've done an awful lot of collaborating with local governments and with local organizations.
Yes, they play a critical role. That's the role that the public-private partnerships result in when we start talking about collaboration on programs like the mitigation program in Alabama. To give a couple of examples, the collaboration that you have with these public-private partnerships can do several things. Number one is for a small program, fledgling program that's growing. And by the way, with the NAIC, I have the absolute privilege of traveling across the country and working with insurance commissioners and their departments on establishing these mitigation programs. And I always mention to them, or at least consult with them on developing these public-private partnerships. What they can do for you, at least at the state level, is they can give you a force multiplier. When you have public-private partnerships with entities like Habitat for Humanity, for some reason Habitat for Humanity is very good at processing paperwork and building homes. Did you guys know that? Very good at it, right? So what you can do is you can utilize that. And another thing that it does is partnerships like that also reach out to those that need it most. They typically have a host or a list of consumers that need the assistance that these programs can bring. And by doing that, what you're doing is you're not only developing a larger footprint of the program, but you're also minding the gap at the home level. Because once you do this, now you have assistance to bring in other partners like the insurance companies and insurance industry to help insure these homes that perhaps maybe weren't insurable before the mitigation programs, or perhaps they are receiving a better product to cover their homes. And we did several of these projects when I was with the state of Alabama. We did a couple of them with insurance companies. One was in the Birmingham area, where in the center of the city, this new stadium was built, giant municipal stadium, and the insurance company had the naming rights to the stadium, but they wanted to do something for the community and start maybe looking at mitigation and maybe bringing up some of the neighborhoods that were located around the stadium. So we entered into a partnership with them and also with Habitat for Humanity and began mitigating homes. And I think I don't remember exactly how many we did. I think the project was wrapping up just as I was leaving the department. But I think we did around 200 to 250 homes in that area. And there again, what we saw is an opportunity for insurers to go in and help offer insurance at affordable rates and a better insurance product than probably what was available before. We saw the same type of program that we initiated down in the southern part of the state on the coast. There's a community down there known as Africatown, very rich history in that community. And in that community, there were areas of it where insurance companies wouldn't even write because of the risk of loss in those areas. So we went in with Strength in Alabama Homes, and we started mitigating homes. And after we did quite a number of homes in a very tight concentration, we partnered with some other partners that came in and did some other work on the homes, so those homes were insurable. And we started seeing that gap being closed in that we had insurance companies going in and writing insurance in those areas, and they were offering really good products, and they were affordable. So we saw a growth in this microeconomic growth in the insurance industry in that area. These partnerships are critical.
You know, Brian, you mentioned the one in Birmingham. That was Protective Life, and we mitigated homes in a couple of hundred homes in 5 historic, very economically challenged neighborhoods in the northern Birmingham area. And if you really want to know what this can do really at a local level and at a personal level, we went around and viewed some of those homes that have been fortified and talked to the individuals, the homeowners. And one lady standing in her front yard looked at us and thanked us and said, "It doesn't rain in my house anymore." It doesn't rain in my house anymore. That's when you know. That's when you know you're doing something that's pretty neat. It doesn't rain in my house anymore. Jerry, let me direct this one to you. What are some of the potential long-term economic benefits for communities that invest in resilience measures beyond the immediate impact of insurance premiums?
Yeah, well, we're talking about measures and ways to fortify and strapping the roof onto the deck, which these are things that can be done. But what about cost benefit? People want to see numbers, and do the numbers actually support the advantages of engaging in those kinds of projects? Well, if you haven't seen it, there's a really good report that came out just a few weeks ago that was collaboration between the U.S. Chamber of Commerce and Allstate Insurance. The title is The Preparedness Payoff, the Economic Benefits of Investing in Climate Resilience. And what the scholars did to produce this report is they looked at the well-accepted ratio of 6 to 1, that for every dollar spent in mitigation and in loss prevention, you get $6 of benefit. This is a sort of a standard that's well known in the industry. I see everyone on the panel nodding. But they went a bit further, and they saw that there's economic benefits as well that are not taken into account with the 6 to 1 ratio in terms of jobs that were lost, people that moved out of the state and weren't contributing to the tax rolls, loss in GDP, loss in productivity. We know the aftermath of Katrina, how New Orleans suffered. And they calculated the economic costs as about 7 to 1. So for every dollar spent in preparing and in helping rebuilding, you have an additional $7 of economic gain, which would be lost absent the measures. So really the ratio is 13 to 1. So it's a compelling set of numbers, and they gave some examples, about 5 detailed examples of realistic disaster scenarios in the Lloyd's market, the RDS, where they talk about what's the worst that could happen. You have 2 cruise ships colliding, you have 2 Category 4 storms or something like that. So they looked at 5 examples, including hurricanes hitting highly populated areas, drought in New Mexico, wildfires in California. They looked at 5 in detail, and they saw the amount of money that's needed to be spent to mitigate, to reduce the possible losses, was well below the actual savings. So it made sense. And in addition to the 5 scenarios, the hurricane, the tornado, earthquake, heat wave, another one, there's an additional 20 that are there where they documented what would be the cost to mitigate and what would be the benefits. So 13 to 1. So that's a really good a good example of what can be done and what the numbers are. And another one is repetitive flooding. Repetitive flooding. The Pew Family Foundation has done really good work on flood insurance. And one example that many of us remember that have read the Pew studies is that a Mississippi home, which was valued at $69,000, was flooded 34 times in 32 years. So after each of these flooding events, the NFIP rebuilt. There was no thought as to, is this economically viable? Well, the actual loss to the government, because the NFIP is a government program, was close to $700,000. So if they just moved that home or elevated that home for like a 5-figure amount, you wouldn't have had this near $1 million loss. And the numbers for repeatedly flooded properties are also pretty depressing, that only 1% of National Flood Insurance Policy Program policyholders are responsible for 30% of the program's losses. So you got this disproportionate impact of repeatedly flooded properties without the incentives to take the right actions, even following the very positive developments of risk rating 2.0. So the numbers are there to do the case studies and to make the argument that could convince people in the public sector or in the private sector with coalitions, with public-private partnerships, or individual companies to make these kinds of investments. So that's, those are some of the numbers.
Time permitting, I want to come back to flood, if we have time. But I want to ask this question, which meshes up nicely with a couple of the Slido questions I'm seeing from the audience, and that is, what strategies can be employed to overcome the financial and political obstacles to investing in community resilience, and what can insurers do, and what role can they play in advocating for some of these investments? I want to direct that first to Leslie.
I think that one of the greatest challenges with resilience is it can seem very future, remote, and far off for ordinary people. And in our work on disaster smart leadership, we talk to mayors and local elected officials and others who have to take finite supplies of resources and turn them into services in their communities. And typically, the squeaky community need gets the resources. So in order to amplify community resilience and the types of investments necessary for climate adaptation and others, there has to be some appreciation in those communities, and those have to be reflected by the constituents, otherwise there's a big disconnect. And I think one of the chief ways to do this, which we need to keep working on, but it can be done, is to make these tactics and strategies understandable and visible. You talked about the Netherlands, and I remember after Superstorm Sandy, we were at World Habitat Day talking with the Netherlands. All of us can work as peer-to-peer conveyors of this message, but we have to make it something that matters to the individuals as well as in the big picture, because we do a lot of behavior-focused studies. We're constantly talking to people, homeowners, policy leaders, and others, and in the end, everyone has a lot to do, but it has to be something that comes all the way home to them. The strategies have to be understandable, they have to be relatable, and they have to have some impact on the community. We're talking about flooding, wildfire, and those types of disasters that are especially important for community-based solutions, unlike with high wind, where if you take steps for high wind on your own home, you have a really good shot at survival. But if you are in a wildfire zone and you do everything you can do, if your neighbors do not, it may not matter. So I think making those points, making them understandable. We were in Epcot for 8 years. I don't know if any of you guys ever went to Stormstruck, A Tale of Two Homes in Epcot. It was 08 to 16. We learned so much about how to message and talk to people from our greatest storytellers in America at Disney. And that was the first thing they said. You know, when it comes to disaster and climate, we're not going to win them over with doom and gloom. We're going to win them over with empowerment, success, and then we fill in the exact recipe for how to make it successful. That's what moves people to action. Human nature and human bias, if we give them the doom and gloom scenario, they're out. They're like, you know what? I got enough to worry about in my everyday life. I got to get my kids to school on time. So I think that one of the ways we can encourage the support for those types of investment is we have to take them out on the road, show people what they mean. A lot of the new technology, AR and other things are allowing us to show people simulations of what it can look like. I like the old stand by the pole and show the height of the last big flood event, which is 5 feet over your head. And people go, oh, okay. So I think that's one of the ways we can do that, but we just have to remember those messages need to be empowering, because scaring people into action, it might work in the short term, but we like to just leave that to the weather.
Fred?
Yeah, so I think that strictly speaking, most people, whether they're consumers, public policy folks, home builders, roofing contractors, they need an economic understanding. What's in it for me? And so one of the most effective strategies that we've seen for market transformation is the development of a grant program, helping to overcome that first cost, at least for a small segment of the population, so that people can understand what needs to be done and they can see that it can be done affordably. So grant programs have been successful in your state. They've been successful in North Carolina. They're growing in popularity in Louisiana. It's coming to Oklahoma. Places like Minnesota, Kentucky are all finding ways to creatively allocate dollars to incentivize a change. It's not only coming from the public sector. There are private carriers that are incentivizing. North Carolina, for example, North Carolina Joint Underwriting Association has invested upwards of $70 million over the past 10 years in their coastal roof mitigation program. Federal Home Loan Bank of Dallas has created a facility in 5 states that they cover where they will lend to partner banks that can then make low interest or no interest loans to folks to be able to affect these changes. All of those things have been widely well received, and they have fundamentally delivered results, which is a really important thing too. On the backside, so for example, in North Carolina, there's been a study done by NC State that looked at 5 landfalling hurricanes since Fortified was emerged in North Carolina, and during that period of time, there was a 22% reduction in loss severity and frequency. So the carrier itself is seeing a significant change in their risk curve. But that investment is one way that municipalities and insurers can get involved. The other is to think creatively. You're not going to get all of what you need out of a premium reduction, especially in inland states. And if anybody's from an inland state here and thinking, well, high wind is not a problem for me, you're fooling yourself. It is a problem for you. It's a problem for everybody. Derechos can happen. Nebraska and Iowa had that July 31st, 90-mile-an-hour winds. It's really important that folks look creatively at other stakeholders in the market that might bring value. Building departments who might accelerate plan reviews for pulling of permits. You need to find ways to also extend benefits to the builders and the roofing contractors, because right now the majority of the benefit comes in the form of reduced premium or reduced likelihood of loss for the consumer. So something's got to also help the contractors see benefit, because there is an upfront cost. There's a training cost, which is relatively small, and there is a hard cost when it comes to investing in products and processes that are more resilient. So those are some of the things I think that insurers can absolutely play a role, whether it's directly through premium reduction or through investments from their philanthropic arms, and as community leaders getting involved in local conversations around building code and incentives.
Thanks, Fred. We have a little bit of time left. Let me go to some of the Slido questions for our group, and here's one that I think is particularly important. It says, can you please elaborate on the role and importance of building codes in enhancing community resilience, including the difference between a fortified standard versus meeting current building codes? Let me first throw that to Brian Powell.
Well, there's a considerable difference, and I would like to ask for Leslie to assist me with this question. And the reason I'm doing that is because she is a building code expert, and she's been working closely with the NAIC and the work that I've been involved in on talking about building codes and advocating for building codes in areas that we're going into. So the difference between typical building codes and fortified.
So we call fortified Code Future because the research that comes from Fred and his colleagues at IBHS makes the case through world-class science and engineering for changing the way that we create our codes. And the code, of course, is a cookbook full of standards. And those are the recipes, but it's a minimum standard. So if you're below code, you're not even up to the base. With fortified, I think one of the best examples of that timeline is the sealed roof deck. And the sealed roof deck research, I'm going to actually do another swing over and let Fred take this discussion of how the research at the lab determined that without a secondary water barrier of some type to create a sealed roof deck, and at certain wind speeds, whether it's a severe thunderstorm or any other type of named event, you're going to lose those shingles, which is the majority of what we use in this country. 9 bathtubs worth of water per minute of wind-driven rain are coming into your attic. So that has made it into the code in certain places, and it's on a trajectory. I didn't know if you want to talk more about how we do that, because then that's a great tee-up. He's got a display outside that you guys can come, and you'll be experts on sealed roof deck by the end of this morning.
I'll try to keep it brief, but the code, let's just level set here. The code is not the same everywhere. There's lots of places that are on codes that from the early 2000s. Connecticut has made the move to adopt a more current code, version of the code that's promulgated by the International Code Council, but there's also a carve-out that says that any place you don't have wind speeds, expected wind speeds above 130, then you don't have to seal the roof deck. Well, I have news for you. The wind has absolutely no idea when it's supposed to not reach 130 miles an hour. It does not pay attention to contour lines on the ground. It doesn't stop. And shingles, which are on 70% of the roofs in the United States, do not last that long. They routinely fail at wind speeds of 60 miles an hour or thereabouts. We just did a display with Good Morning America that it really vividly showed that. So building codes are not the same everywhere, and that's something that's really important for people to understand. The biggest things is Leslie alluded to, we pay attention to how the roof deck is attached and how the roof deck is sealed, so that if the primary cover is lost, it can resist the water intrusion. Another key place where the code needs to improve, particularly inland, and where Fortified provides guidance, is around the garage door. Garage door is typically the largest opening in your house. If you're in a tornado-prone area or a high wind-prone area, here's something you need to know. If your garage door is not properly pressure rated, it can be just the simple force of the wind can cause that garage door to collapse. When it does, the air rushes in and pushes out on the walls and up on your roof, and that's when you get catastrophic structural failures. And replacing a garage door with a properly pressure-rated door can cost you less than $1,000. But people just don't know it, including builders, away from the coast. So we're driving the adoption of properly rated garage doors. There are other more technical intricacies that I'm happy to talk to anybody about, but the building code has, from a wind perspective, along the coast, has generally, from the IRC, the International Residential Code, has generally included a lot of the science, including the sealed roof deck now. But municipalities rarely adopt the latest code on a regular basis, and not all municipalities enforce it well, unfortunately.
Someone asked the other day, what are some of the main elements that have to go into a successful program outside of what we've talked about today in terms of collaboration between industry and academia and government and stakeholders of all kinds and partnering in these collaborations, but it's your fortified program. It's the mitigation program. It's building codes. It's the wind mitigation discounts, which give discounts on your premium. You have to all that pulling together, and that's what makes a successful program. We have just a couple of more minutes left, but I want to come back to flood. I didn't want to miss that one, because a lot of people think flood is included in your homeowner's insurance, and most people don't even understand flood, don't even think about flood. So let me throw this to Jerry. How can we move the needle out there on that?
Yeah, thanks for the question, and you're right. A lot of people don't know that flood is not covered in the HO3 or the other homeowners policies, and so there needs to be more education, and we haven't talked about insurance agents, distributors. I think there's a role for agents to play. I think it actually could be an E&O exposure, errors and omissions, for not making options available and educating their clients into what needs to be done. Some departments around the country have got videos with cartoons. So a combined effort from the agents and the insurance departments and the state governments. But if I can go back, Commissioner, to the building codes question, I'd like to answer that with a question. What city that begins with the letter H has got the most insurance company headquarters?
Anybody? Anybody?
No.
Anybody?
No, it's Hamilton, Bermuda. Sorry, Commissioner Mason. Hamilton, Bermuda. Now, who's been to Bermuda? A lot of you have, and you're struck by the limestone roofs that they have there, right? Beautiful white limestone roofs. They're very heavy, and some of them have been around for 200 years. So that can withstand a storm, which often goes through Bermuda. And to Leslie's point, yeah, you don't want to be coerced, but they've got a strict building code that if you have a house in Bermuda, you have to have that kind of a roof. Not only does it reduce damage, but also it collects water, because Bermuda is a dry island, no fresh water. So the water comes down in rivulets from the roof into underground cisterns. So they've solved two problems with one building code, and sometimes coercion works. I'm not suggesting that, but just pointing out Bermuda.
That great curveball there. I love that. We've got a couple of minutes left, so let me finish up with this one. A Slido question from the audience. What's the biggest misconception about resilience that you wish more people understood? Leslie, quickly.
That it's complicated, expensive, and hard, and it's not going to happen to me, so I don't need it anyway.
Misconception, right? Got it. Jerry?
Misconception that I'm covered, and it can't happen here, not in my yard, but it does happen.
Brian?
Nothing's going to happen to me, and I don't need this. I've seen that quite a bit. I don't need the mitigation. I don't need the protection. And if I do try to get it, it's going to be unattainable and very expensive.
Fred?
Well, I agree with everything that was said, and I'll try to be a little bit different, that the customer won't pay for it. It's a misconception. They will. They see value in it.
Is it worth it? Leslie?
Absolutely. And it doesn't have to, you don't have to have a disaster for that to come true. Just the way people tell us in those many studies, how they feel when, it's winter freeze, severe convective storms, what we like to call thunderstorms, but the industry calls them that. Whatever it is, it's just knowing I'm okay. I've done everything I can do within my power to protect myself and my family. Safety tops out in all the research as the #1, with cost coming right behind it.
Jerry?
2 words, the Boy Scout motto, be prepared.
Love it. Brian?
Is it worth it? I'm going to answer that with a question. Are you willing to bet your home on it? Are you willing to bet your livelihood? And are you willing to bet your life?
Fred?
Yeah, I do this every day, 16 years. Yes, it's worth it.
Thank you all. Fascinating. Jim Ridling would be proud. Thank you for being here.
Thank you.
We stand between you and lunch, so we knew we had to finish on time.
Actually, technically, I stand between you and lunch. Thank you so much to the panel. Good to see everyone. My name is Dan O'Keefe. I serve as Commissioner of Economic Development for the state of Connecticut. I was supposed to introduce this panel, the timing shift, so now I get the enviable position of being between you and food. But I was excited to come talk to you today. First, because I was excited to welcome a bunch of Southerners to the state of Connecticut, paradise, where our weather is like this all year round. 2, I was excited to talk to a group in the insurance capital of the world. No offense to Bermuda, but I would argue we are actually the capital of insurance expertise. You know, we are the market for expertise in what is an incredibly nuanced industry. And I was also excited to talk about resiliency, because resiliency became deeply personal to me 3 weeks ago. It sounds like it's been referenced, but 3 weeks ago we did have what they refer to as a 1 in 1,000-year storm on a day when we didn't have a flood warning from the National Weather Service. We received somewhere between 12 and 14 inches of rain in certain parts of the state, and we had a flash flood. And 3 people lost their lives. People lost their entire homes. Over 200 small businesses, the lifeblood of our economy, were wiped out. And the communities impacted, places like Seymour, Oxford, and the surrounded areas, were not prepared for a 1 in 1,000-year event. I have toured the damage. I have spent time there with the governor, we've met with one of the widowers who lost his wife. We met with a woman who lost her entire home and is currently seeking alternative housing with her family. We saw the devastation that showed up in a blink of an eye, literally what they call a flash flood for a reason. And virtually no one had flood insurance. And if you go to this region as a rational human being and you look at a river that's literally called the Little River, and when we visited post the event, clearly it was a small bubbling brook, literally, with stone riprap on both sides. No rational human being could ever look at that and say, I'm at risk of a flood. And what I want to call upon all of us to think about in the insurance expertise capital of the world is this concept of separating flood insurance from homeowners insurance. I'm sure there's all kinds of reasons why that was done, but what I will say to you is if you're a rational homeowner, you have almost a genetic inability to efficiently and effectively price a 1 in 1,000-year risk, but actuaries can. And so I'd just like to get us all thinking about that and whether that still makes sense if these so-called black swan events, these 1 in 1,000-year events, are going to be happening more frequently, because I think that's the risk in front of us. So on that light note, I want to thank you very much for coming today, and enjoy lunch. Thanks again.
Thank you so much, Commissioner O'Keefe, and unfortunately I now stand between you and lunch, so I promise it's going to be very quick, but I'm Kate Bauman, the Chief Operating Officer with the Metro Hartford Alliance. Talk about an incredible morning. I know I now have my list of to-dos of updating my home insurance policy, my garage doors, so I think I have a lot of things to do. I see a lot of nodding heads there, but truly an incredible morning, so thank you to our speakers, our moderator. And I'd now like to take a moment to extend a welcome to our future talent. In our audience today we have many undergraduate and graduate students joining us as part of our Future Talent program, and special thanks to Symetra for their sponsorship of this program. So to the future talent, we say welcome, and I love giving a little round of applause there. We have students, thank you. I love it. You can see the energy. It's fun. I can see everyone's face is very bright up here, which is wonderful. And really today we have students from the University of Connecticut, University of Hartford. We have a group of students that have come up from Columbia University. So really, and there's many more. So today I encourage everyone to say hello, because truly each of you, your students, each of you, your presence here is truly special to us. And really hope today can provide you with an invaluable exposure to really the dynamic world of insurance and financial services. I always do joke, as someone not from the insurance industry, there is a lot of cool things within the insurance industry. So hopefully today is really just an additional spotlight to that. And really today also encourage all of our young professionals is to go out and network. This room is filled with many leaders here, not only in our region, but also throughout the industry and throughout the country. So encourage you to go and say hello throughout the day. And really attracting and engaging future talent is essential for the continued growth and really success of not only the insurance industry, but also of our Hartford region. And at the Metro Hartford Alliance, it's a core initiative of our mission, with our talent efforts being fueled by HYPE, which is also known as Hartford Young Professionals and Entrepreneurs, which is the Talent Retention and Attraction Initiative of the MHA. So to the future talent here today, thank you again for joining us. Please network, share your insights with us, and let us know how we can help you in the next steps of your career. And we hope today really truly inspires you and ignites the passion and showcases the impact you can make here on the industry. So as I mentioned, next is lunch. I promise we're getting there because I know people are hungry, but during this time we encourage you to visit our photo booth, which is right outside the doors over here to the right-hand side when you exit. The photo booth is sponsored by NASA, and NASA not only made today's photo booth possible, but also was a big supporter. Last night we had the pleasure of welcoming speakers and sponsors, and as Susan had mentioned earlier, over 30 regulators welcoming here to Hartford at a small reception at the DoubleTree by Hilton. So an incredible night, so a big thank you to NASA. And really, last night was a great way to kick off this event, but also Hartford Innovation Week. So if you haven't checked out all the other events that are happening throughout the week, definitely encourage you to do so. And now, without further ado, to go have lunch is you can exit out the doors on the right. You can head upstairs. We're going to reconvene the program sharply at 1:30 p.m. with our second panel, Innovative Risk-Based Mitigation. So we'll see you back here at 1:30. Anyone who is a regulator, if you don't mind hanging back just for a moment, come right up to the stage. We're going to take a quick photo of everyone. So thank you and enjoy lunch.
Hi, good afternoon. I've been asked if folks could please take their seats, silence your phones. So good afternoon, welcome back to the afternoon session. I'm Dr. Rebecca French. I'm the Director of the Office of Climate Planning for the Connecticut Department of Energy and Environmental Protection. My office is tasked with developing and administering climate action plans for the state of Connecticut to reduce greenhouse gas emissions by 45% by 2030 and 80% by the year 2050 to prevent the worst impacts of climate change, as well as helping the state adapt and become more resilient to the impacts we are already seeing today. These are critical goals for our state, so I want to thank Commissioner Mays and the Connecticut Department of Insurance for organizing today's event and for inviting me to introduce this next panel on innovative risk-based mitigation, the role of insurance in resilience, and nature-based solutions. So before they come out, just a few more remarks. Because they are going to be talking about nature-based solutions, I wanted to give you a local example. If you happen to take the train to Hartford today, coming from the south, you pass by one of the best examples in our state of using nature-based solutions for climate resilience. After multiple devastating flooding events impacting housing and businesses in the downtown, the city of Meriden decided to restore the Harbor Brook that had been buried underground in pipes and had been causing that flooding. Today, if you go to the city of Meriden, there's a 14-acre park, and the brook is flowing through it, and the park does still flood, but it floods a park, and it no longer causes any damage to those homes and businesses. Instead, development has grown up around the park with new housing and new businesses. During dry times, the park serves as recreation space. It hosts farmers markets. There's a beautiful bridge that you walk across to reach the train station, so you really can just hop off the train and see this nature-based solution for flooding. It's also a cool place to sit with trees and shade during these increasingly hotter summers that we are experiencing in Connecticut. Although everyone has been remarking on the weather today, it is beautiful in September, but it has been a hot summer here. So what this new, what we call the Meriden Green did, it didn't just prevent flooding and prevent damage. it strengthened and revitalized the community. And that's, what we really want to achieve with climate resilience, is to have all of these outcomes. And I know my colleagues earlier, Commissioner O'Keefe, Commissioner Mays, remarked on the recent devastating flooding that we experienced on August 18th. And as we look to begin our recovery in the state from those impacts, I hope we can take some of these lessons that we've learned from past flooding events and how we've, and to rebuild with resilience and recover with resilience. I'm sure you're going to hear more examples of climate solutions in this next session that will explore how insurance can help reduce financial risks, ensure economic stability, and promote sustainable practices that benefit both insurers and communities. The speakers will also delve into the role of nature-based solutions, as I said, highlighting innovative approaches that integrate natural systems to enhance resilience and mitigate risk. Are the folks coming out? Okay. Well, I'm going to say their names. So I'm very pleased to introduce the moderator, Frank Tomasello, the Executive Director of the Institute's Griffith Insurance Education Foundation. Our panelists are Superintendent Beth Dwyer of the Rhode Island Department of Business Regulation, Lars Powell, the Director of the Alabama Center for Insurance Information and Research at the University of Alabama, Natalie Anclave, the Executive Director of Build Strong America, and Russell Stack, the Director of Catastrophe Analytics at Aon. So thank you very much.
Thank you. It's a pleasure to be here. It's a pleasure to share the floor with these outstanding thought leaders today. Together, we'll explore the role of insurance in risk-based mitigation and resilience, and consider the role of nature-based solutions over the next 40 minutes or so. This morning, Susan Winkler, during her opening remarks, spoke of the increasing frequency and severity of losses due to climate issues. And Commissioner Mays talked a bit about the power of collaboration to address these existential threats. To begin our conversation this afternoon, panelists, may I call upon you to spend just a couple of minutes to speak to the current climate risk landscape, and perhaps to the importance of using a variety of tools in the risk management toolbox, as it were, to meet the moment. Lars, would you care to kick things off?
Well, as a recovering risk management professor, I love to hear myself talk and can't think of a better thing to talk about. So yeah, I'm happy to. Thank you, Frank, for the invitation to be here and talk about this important topic. So we've got these several risk management tools, as you say, in our toolbox. And a lot of them would be really bad for these climate risks. Things like separation, diversification, duplication. Everybody can't have two houses to live in or two buildings to work in. So we're left with some of the more obscure ones, at least from the way we teach it in class, because I've always taught in a business school and we can't teach how to build anything except a portfolio. So we can do pre-loss mitigation, meaning we can build better buildings. We've got a lot of evidence that that works well. We've got some new stuff hot on the press that if we have time I'll talk about later from Hurricane Sally. But I think from the nature of the question, the answer is we can invest in information. That's what we've been doing in Alabama, along with all of the creative things that we've tried. An insurance company can't do anything with the information until they can believe it and they can quantify it and they can measure it. And so it's important when you're thinking about risk management is you've got to have all the information you can have. You've got to know, well, we think if we build up this coral reef as a nature-based solution that it will reduce the expected frequency and severity of flooding and or hurricane wind risk. But we don't know that until we've measured it, and that's an investment in information. It's one of my favorite risk management approaches, risk management tools, is this investment in information. but it's something that every insurance company can participate in. We know that you do it in behind closed doors, and to the extent you can help us with it, then that's great. But yeah, it has to be, the information has to be there before we can start implementing these things.
Thank you, Lars. Panelists, care to add any color to what Lars just shared?
I think, first off, thank you for having me here. I think just to build on that, I mean, information is extremely important, and being from the CAP modeling side, we're able to take some of that information and start quantifying it. So as being able to bring in this information, such as, if you do the coral reef or you build a more fortified structure, like how does that get into the models? Can we actually model that and show that benefit? That is going to be extremely important as well. So.
From the Build Strong perspective, we started as a building code coalition, and then as climate started becoming a much bigger topic and we started recognizing that, we have to throw all the tools that we possibly can into our toolbox and throw it at climate. So it's not just building codes anymore, it's expanded. It is these public-private partnerships. So to echo Lars and Russ, we need to pool all of our resources. So take everything we possibly can, throw it at the situation, to link, leverage, and align to get to ensure that it's a coordinated approach. So I would just add that as well too.
Thank you, Natalie. Superintendent?
So from the regulators' approach, of course, we're not the people doing the experiments or modeling, but we do feel that we have a duty to get out information to consumers. And we were talking at lunch about how frustrating it is to try to do that. How do we get consumers to understand how this would benefit them? I do recall about 15 years ago in Rhode Island when we were discussing risk mitigation, we heard, well, why should we benefit the insurance company? Why should we do something that makes their loss less? Well, you need to realize, if you're that unfortunate person whose home is destroyed, you might have alternative living in your driveway for a year. That's not pleasant. It's not all that just because the insurance company is there and you have a policy that covers it, that you will not suffer harm. So how do we get that across, and how do we encourage people to mitigate and understand what the mitigation means?
Thank you. I'd like to spend some time exploring, we heard a little bit about CAD modeling and risk assessment and consumer education, and rest assured we'll devote some time to explore those topics. Before we do, perhaps we can drill down a bit on specific risk-based mitigation and resilience projects that insurers might invest in, and how might those projects impact financial risk exposure. Anyone care to take the lead there and share some thoughts?
You know I will, but go ahead.
Go for it.
So the hard part about this, especially talking about when an insurance company is going to invest in one of these sort of public projects, is you don't have anything to bind the policyholder to the insurance company. So if you do something to strengthen a policyholder's home and then they move to another insurance company next year, it hasn't done you any good. So we've seen the North Carolina JUA, their wind pool, do some of this because the folks on the Outer Banks are sort of stuck. But and also the wind pool's job is to put themselves out of business. But from these other things, I think the one avenue you have where insurance companies can participate is insurance companies are some of the largest investors in municipal bonds. And so my favorite nature-based solution for wildfire is to put a municipal golf course between neighborhoods or between the WUI area and a large densely populated area. So issuing bonds to build that golf course or park or softball field, having a big open area as a fire break is a really good idea for places that are struggling with wildfire risk. And to the extent that an insurance company would be purchasing those bonds, there's some argument to be made that there might be some concession in the price if it's going to reduce the overall risk. Again, if I wouldn't be standing up here saying that if I worked for an insurance company, probably, but I think that there's that discussion to be had.
And, you know, in recognition of what Lars says, we need to thank Alabama for their strength in Alabama homes. And I think more and more you're going to see states adopting a similar approach where the state is getting the money to the homeowner to make the house more resilient, because you're absolutely right. The next year it might be a different insurance company. And we actually have some data now with Alabama, having done it for a number of years, and I think with more and more states coming on board, we'll have more and more, data. Alabama was not the only state. My understanding was Louisiana and Florida both had the program, but didn't have the funding. So the funding is absolutely critical. And through the NAIC, the state insurance regulators are really encouraging funding from the federal government, appropriate tax treatment of funding that we get through, programs like Strength in Alabama Homes. And, then getting out to the consumer, why is this important? How does it benefit you? And how is this funding assisting you in making your roof more resilient in this part of the country, or wildfire risk? I actually had my roof done about 4 years ago. And we had been discussing tape, which is a very cheap, not expensive, and it does have a lot of, and I asked the roofer, and he literally didn't know what I was talking about. And the reason he didn't know what I was talking about is it wasn't in the Rhode Island Building Code. It was in the Connecticut Building Code, but the roofer in Rhode Island is not going to learn it unless it's of no value to him. He's going to walk up to me and talk about tape if I don't know what he's talking about. So, building codes are so important. If you get it in there, the vendor is going to understand what it is. So someone like me who's unusual and asks, but he couldn't do it for me because he didn't know what I was talking about.
So Natalie, I see your head nodding, and given your area of expertise, please, appreciate your gloss here.
I was just thinking about my own personal story with my HOA, how they're about to replace all of our roofs because of end of life, and I was asking, oh, well, can you just allow us to pay the difference for a fortified roof? And they told me that was a scam by the insurance industry. And my mind was blown. So, yes. So, anyway, so investing in resilience and how insurers can reduce claims, kind of on this same path. The insurance industry does invest in many programs. So, Wildfire Prepared Home at IBHS, specifically out in California. I think I saw Commissioner Lara out here. They're doing great work out there. But for me, listening to this morning's panel, public awareness campaigns, I think, is something that we really need to invest in. I'm a former FEMA person, and to hear the lack of knowledge around flood not being in a homeowner's policy was really interesting to me. Where it rains, it can flood. And so that's something that would be great if we can invest in that a little bit more. But yeah, and workforce development, of course. So also the insurance industry invests in Build Strong America, where we are investing in workforce development through a Build Strong Academy. So.
Yeah, I think I just want to echo a lot of what was said here. I mean, education is something that's drastically needed. Having come into the industry with no insurance background at all about 12, 13 years ago, I had very little knowledge about flood policies and any of that sense. And it's extremely important. I mean, now I get to tell family members, like, why don't you have a flood policy? Why don't you have an earthquake policy? Those are all extremely damaging perils for them that they wouldn't have any knowledge on. They would think the regular insurance policy would cover it. In terms of like insurance and natural-based kind of mitigation, I think being able to have some of that defensible space, so going back to the golf course analogy, that does provide that buffer, and I would hope that insurance companies can start building that into their rating plans. You have these if you have a buffer, you have this mitigation in place, whether you're closing off eaves, you have a buffer, you have even ice plant around your property. That's a wildfire mitigation, just sticking on the wildfire example. All those, if it can be transferable, and I think that goes back to codes and rating agencies, making sure that's put into the books so that insurance companies need to follow it and have a way to quantify and provide that premium discount.
Yeah, to Lars's point and Russ's point here, we need to invest more in research on how do we put nature-based solutions more into CAT modeling, because that's been a challenge for the industry.
And we accept that money.
Let's shift gears a little bit. The insurance industry possesses expertise in risk management in many ways, but risk assessment and modeling are a couple of areas of great expertise within the industry. How can that expertise be leveraged to enhance the effectiveness of resilience projects? That's an area I'd like to explore with the panel. Perhaps a good place to start is maybe to ask you to speak to the state of risk assessment tools and modeling approaches employed by the industry. Russ, can I call upon you to maybe kick that off? And it may be helpful for some folks perhaps in the audience to maybe appreciate a little bit about sort of the history and the evolution of modeling so that we have some context in terms of where we are today.
I'll do my best to do justice to that. So modeling in the early stages was relatively crude. Didn't do, there wasn't a lot of science to the back end. There wasn't a lot of vulnerability. So when I talk vulnerability, like what type of structure, there was just base sets that you could look at. So results obviously were very high level. I think you can argue today it's much more detailed. There's a lot more money invested by modeling firms to actually do large studies. We call it a black box, but they do have a large scientific team that are figuring out the hazards. They work with engineers so that they can understand the vulnerability. Nothing's perfect. I think being a model, it's wrong inherently, but at the same time, it does provide a very valuable set of data and information. Outside of the models, if you want to get model agnostic, you can go into hazard scores. So this is understanding the hazard. This is something that is used in the underwriting process, which I think can also be merged into understanding where could we do nature-based solutions. In high hazard areas that can identify like, hey, we need to do the golf course, or we know that there's a high flood hazard here outside of what FEMA designates. That's where you could start looking at different types of flood projects to help mitigate those types of impacts. And then kind of evolving from that, you now have climate models. So going into the climate change aspect, at Aon we have a climate risk monitor that helps aggregate some of that data and give you some portfolio level analytics on different perils that are kind of in the climate change realm. And then also to build on that point, a lot of the modeling firms are now starting to invest a lot of money into the climate change. So you're getting what's called climate condition curves, to where they're trying to forecast out 30, 40, 50 years to understand what could this loss look like.
Thank you, Russ. Appreciate that. Thoughts from other panelists? Anyone care to piggyback there?
Sure.
Lars, I'm stunned that you...
Yeah, well, I'd like to hear myself speak. I'm sorry. Data. Insurance companies have lots of it, and the rest of us have very little. Many of the questions that we'd like to answer, we don't have the data to answer. I understand why some insurers don't like to share their data. We recently did a data call from Hurricane Sally in Alabama. Commissioner Fowler made that happen, and now we have a wealth of information on how these different technologies work, and we're going to be able to get as specific as how old is your roof before it starts to perform worse, and the specific wind speeds that are affecting different types of homes, and it seems like that would already be very well known, but it's not. Some of it's in a bit of a black box with Verisk and RMS models, but some of it is just it's right there, and we aren't permitted to look at it. So I don't know if it's worth still asking the insurance companies to share data as much as asking the regulators to work with your local universities or with my university or anybody that's qualified to do it, and get the data in and process it so that we can understand some real answers to big questions.
Thank you, Lars.
So I couldn't agree with that more. I don't know if we can give you any data, but getting the data and understanding what is actually happening as opposed to making assumptions, that's the way we're actually going to move the needle. Through the NAIC insurance regulators, we have to understand these models. Very few of us have the education or background to do it ourselves. So the Center for Insurance Policy Research has put together the Catastrophic Modeling Center of Excellence. And the purpose there is to have people who do understand the models that we can go to for explanations. 15, 20 years ago, of course, my state is essentially all coast. And so we started seeing some of these effects of insurers wanting to leave coastal areas. And so there were two modeling companies out there back then. And it was RMS and I can't remember the other one. And this was unhelpful. Insurers were coming before our legislature, and their answer to why our insurance premiums going up was, oh, the reinsurers are using models. It's all the reinsurers' fault. And I understand that it's easy to put it off on someone else. No one wants to be the center. But what that meant was the legislatures then said, oh, okay, so we'll put something in law that you can't use that model. That's not an answer. That's understanding why the model is saying what it's saying and how that's affecting things is the answer. And so that's what we're trying to do with CIPR, so that we'll have the information when our governors, when our public policy people, when our legislature want the information.
Thank you, Superintendent. Russ, anything to add? I don't know if I thought I saw a head bob there, so didn't want to exclude you.
Modeler.
Superintendent, if I may, to kind of follow up, this may be a good opportunity to speak a little bit and obtain your thoughts maybe a bit further on this balance between innovation in the form of enhanced CAT modeling, right, and the need to understand what's in the black box, as it were, and to balance that with the interest of consumers, right? A delicate balance for sure. Appreciate any further thoughts you have there. I think that's a topic of, I would imagine, of interest to many in our audience.
Yeah, so we're always frustrated as regulators when we get calls from consumers and we can't get an explanation for them of where the rate is coming from. That is very important in insurance. If you think about insurance as beneficial to the conversation, it's giving the signals. So if you have a red Corvette and 9 accidents, you're going to pay more for your auto insurance. The signal it's giving you is stop getting in accidents and don't buy a red Corvette. We need the same thing in homeowners. We need homeowners to understand resilience measures that they have taken have assisted, but you still have a risk because you live in Newport, Rhode Island on the water. And aren't you lucky to live in Newport, Rhode Island on the water? So we really do need to be able to explain to consumers where rate increases are coming from, how their rate is paid, and some of our frustration has been the black box. And some insurers, and I'm not saying all, you'll go to them on a specific consumer and say, well, if I don't give you precisely the exact amount, you're going to fine me. I have never gone to an insurer to get an information for a consumer in an attempt to fine you. That has never been my motivation. It's always been the motivation to get the information to consumers. And I've never encountered another regulator who wasn't really just trying to get information. If we can give general understandings, 30% of your rate increase was attributable to an overall rate increase. 10% was, whatever it's attributable to. It will give people the type of information that they can utilize to hopefully take actions to make themselves safer. Someone mentioned Bermuda earlier, and they just got hit, direct hit, by a hurricane, and virtually no damage. I was talking to someone from Bermuda, he said almost nothing, because they've built to it. They know they have the risk, and they have built to that risk. And how can we get there in the United States to get people to build to the risk and lower our overall damage from these catastrophes?
I think education is extremely important in this realm. I mean, I have the fortunate ability to understand typically where some of these price increases are happening on my own insurance, and I love talking to the agents, asking them like, so what's going on, why is this happening, kind of already having an idea. But that's where, you know, the reinsurance comes in, and lately there's been so much cat loss that reinsurance costs have gone through the roof, which is cutting down on the insurance's bottom line, which means then they have to go out and raise rates and kind of build back what they've been paying out. So having the consumers fully aware of why things are moving rather than just saying, oh, it's up 20% this year and it was up 20% last year, like, so what's going on? That kind of black hole of transparency, I guess you could say, is really painful to the consumer.
Yeah. And just to throw this in, the consumer thinks that the insurers are making money hand over fist right now, and they're just not. It's that positivity bias that this is not going to happen to me. And so that's why we just have a problem with building stronger, not being more resilient just generally. So to help with those premiums, driving them down.
Speaking of some education, these numbers are hot off the press. They're preliminary, but from our data call, I can tell you that compared to standard homes, the fortified gold houses in Hurricane Sally had 36% less loss severity. That's among homes that had a claim. The claim was 36% lower. For fortified roof, it was 27% lower in severity. For loss frequency, gold fortified compared to standard was 65% less loss frequency. 65% less loss frequency. That's enormous. And then for roof, it was 48% less loss frequency. Those are numbers from the last storm, looking at 50,000 policies that had 10,000 claims, and there were 9,600 fortified homes in the path. So included in those. That's a legitimately credible, if we've got any actuaries in the room, it's a credible sample. And we've still got some things to do to refine it, but the loss ratio, taking into consideration premiums, the loss ratio for fortified gold was 55% lower than that for traditional houses, and for roof it was 47% lower. That's with the mandated benchmark discounts we have in place, meaning maybe those discounts could be a little bigger. So I feel like all the news is very positive in terms of we've figured this thing out, and we just need for everyone else to understand it and be confident in using it. There's plenty of caveats that go with that, so I'm not saying that this paper's ready to be published. I got the data day before yesterday, and I've been furiously scrambling over it for a while, but those are the top level numbers, and they won't change. We'll be looking at where the wind was stronger and where you were closer to the coast and things like that, but overall, you know, those are big numbers from a large sample.
Lars, thank you for sharing the preliminary figures with us. Very, very encouraging. And maybe a good segue into some discussion around what incentives insurers might offer policyholders to encourage participation in risk-based mitigation and resilience efforts. Sort of open that up to the floor here. We touched upon a couple of things here in conversation already, but anyone care to jump in and maybe delve a bit more deeply?
I'll start. I think this is where our state-based regulation of insurance really excels, because it really varies depending on where you live. So while New England, or maybe even southern New England, has very specific roof tie downs, hurricane shutters, a few other things, that is not going to be what you're going to do in California. They're not having a hurricane. So we would love more data about how efficient these mitigation efforts are. And most of the statutes that I've seen that set up something similar to Alabama Safe Homes actually rank, or list the types of mitigation efforts you should encourage by where you are. CIPR also has a great pamphlet on state resilience efforts that lists by category of threat, so tornado, hurricane, wildfire, what are the risk mitigation efforts that would have the most, bang for your buck?
And CIPR, I'm working with them as well on a white paper and best practices for setting discounts based on Fortified. We've hired the modeling firms to model it a bunch of different ways, and then we're just going through the whole process of what we did in Alabama back in 2015 or 16 or 14, whenever it was that we were able to get those benchmark rates set. There's a lot of decisions you have to make, and we want to make this document's going to explain how we approach each one of them and the different things you might do based on how your state is similar to or different from Alabama.
Natalie Russ.
Yeah, I'll jump in. Other than premium discounts, which everybody wants and is chomping at the bit to get, providing grants on financial support for the mitigation programs, kind of like Safe Alabama Homes, right?
Strengthen Alabama.
Strengthen Alabama Homes, providing those funding for those grant programs, which, by the way, I know we're not talking politics, but there is a retrofit pilot that will be signed into law this year, so that's exciting. Look for that to come. Possibly endorsements for resilience upgrades. And if anybody can figure out how to work with HOAs, trying to get them on board with it, that would be a huge incentive for me, at least. But.
Yeah, I think sticking with the modeling side for me, would obviously premium discounts, as you mentioned, everyone wants to get those, but finding a way to kind of implement that into the modeling so that that can be captured for when they go to get reinsurance, and that cost can come down and then feed through to everyone else, because it is a business for them, so they got to be able to make money, but also they got to be able to serve their employees, their customers. So.
Thank you. If we step back a pace or two, perhaps we can talk for just a couple of minutes about how significant you believe risk-based mitigation and resilience projects to be with respect to long-term economic stability. So sort of stepping back, panning out with a wider lens, what will that mean long-term for the stability of communities? Anyone care to opine a little bit further? Obviously, we've talked about this. There was some discussion earlier today on this topic as well, but given the comments about consumer education that we've had, I wonder, are folks perhaps fully aware of that impact?
This comes up a lot in western Alabama, where we have the distinction of the most expensive tornado in the history of recorded tornadoes. It dug a ditch about a mile wide from Tuscaloosa to Birmingham in 2011, and it was terrible. But we're also an economy that depends on manufacturing, and do you really want to put your new Toyota plant in front of where you might have a tornado like that come through, or hurricanes? There are some things that have to be built on the coast, and so they have a lot of questions about where are our employees going to live after this storm. We run 3 shifts at the Austell military plant in Mobile, Alabama, and if there's a storm, then their people are going to stay home and keep their family safe and do these other things. So I know that Walmart won't do business with anyone that doesn't have a backup plan if they live in a hazard area. I remember that came up with one of the companies when I lived there, and they had to actually buy a secondary office in case a tornado or something or an earthquake hit their primary office, and this was their dental insurance provider. It wasn't like that. This wasn't a brick and mortar thing, but they didn't have a plan, and so we got together and said, well, this is the best place you could put it so that one event won't destroy both buildings. So it's a huge economic development thing. When you've got inexpensive non-union labor, sometimes you can get around those things, but everybody's at a disadvantage that has any sort of natural hazard that could take your workforce away.
I think in terms of like a community being more resilient, I think there's a lot of cost savings across the board, whether that's with the community itself and the insureds within that community, as well as to the insurer, because the more resilient a community is, the less likely, if is some sort of an event, that you're going to have longer business interruption, for example. That's a huge cost to an insurance company. So more resilient communities should theoretically bounce back quicker, which will hopefully help mitigate a lot of those other costs. So if you can educate a community on being more resilient, as well as getting the insurance companies to kind of recognize that, I think there's actually a benefit all around there.
You know, we've discussed the lack of take-up of flood insurance, as did the prior panel. And, you know, as Connecticut just experienced, Vermont has had a number of floods. There isn't the insurance backup there. So when a community is hit by a flood, you don't have the average person being able to, you know, if the take-up of flood insurance is 4%, that's not going to really help your community. You know, in Rhode Island's our tagline on our license plates is the ocean state. I've been trying to get that changed so no one will notice, but our largest flood event was a rainstorm, a rain event. Connecticut's also with huge coastal exposure just had a rain event. The former South Carolina commissioner used to say, do you need flood insurance? Does it rain at your house? You need flood insurance. But communities, so until we get to that point where flood is included in your main policy or there is more of a take-up, it's incredibly important for the resilience of the community to just be able to come back from a disaster like that.
Yeah, absolutely. So I echo everything, but also on a grander nationwide scale, it reduces disaster recovery costs and gets us back rebounding quicker. We've all heard the study. I would hope we've all heard for every $1 we save 6. That can go up from every $1 we can save up to 11 if we go above code. For critical infrastructure, 18. But yeah, it gets us back. Job creation, economic growth, property value. Lars has a wonderful study on that. And then definitely just getting us, the more that we're able to build stronger, drives down that disaster costs for the taxpayers just generally across the board. So,
thanks, Natalie. I should take a moment to remind folks that they may submit questions using the Slido app. I should also confess before this body that Commissioner Fowler set the bar very high in terms of the use of the iPad to view Slido questions. He also referenced his request for an 8th grader to assist. He did not need that. If that 8th grader has been identified, though, well, I'm open to that assistance, just for the record. But we'll take a few minutes here to cover some of those questions here shortly. We've explored a number of concepts that offer great promise for the insurance ecosystem. And I thought we might turn for a moment or two to the other side of the coin and talk a little bit about some of the challenges that we're facing in terms of promoting and implementing risk-based mitigation and resilience projects. Perhaps we can spend a couple of minutes on that before we think about opportunities to address those challenges, which is also important. Who would care to dive in there?
I'm happy to hop into this. Going back to my former FEMA days as the Director of Individual and Community Preparedness, it is definitely, people do not think anything is going to happen to them. We used to run the National Household Survey, and about 56% of the country would respond that they believe they would be impacted by a disaster. The most interesting of that was after COVID, 76% thought they would be impacted by a disaster. And whether you believe whatever about COVID, you were still quarantined, so you were impacted by this disaster or event. So it is definitely people just have this positivity bias. It's not going to happen to me. The best quote was from Amanda Ripley's book, The Unthinkable. If you have not read it, you absolutely need to read it. It is fantastic. It is why people behave the way they do in a disaster. The most deaths, and I'm going to botch this quote, but the most deaths in Hurricane Katrina were caused by Hurricane Camille because people survived Hurricane Camille and they did not think they needed to evacuate in Hurricane Katrina. So it is absolutely, it's not going to happen to us. So
So we have that problem in southern New England because we really haven't been hit by a hurricane. So we have huge hurricane risk, but our last hurricane was Hurricane Bob in 1991, and that was a Category 1. And honestly, there was a little bit of damage, but nobody remembers Hurricane Carol in 1954. The vast majority of people were not alive, and that was a Category 4 or 5. People died. 1938 was the same. We have the risk. But the average person is like, well, it wasn't in my experience. If I don't experience, I don't believe it can happen. And how do we get over that? I'm somewhat, I think it's more in the media now that disasters are getting worse and we should be. I am also the banking regulator in Rhode Island, and early on when I moved into banking, because I'm really insurance background, I kept hearing from the lenders, well, they don't need flood insurance. So, that to the consumer is that somehow you're covered, as opposed to you don't need to buy it for your mortgage. So that kind of misinformation, if we could figure out a way to get away from that kind of misinformation and let people know that there really is a risk out there, I think it might be able to move the needle.
I would talk about the difficulty in spending FEMA funds when you've had a loss and there's pre-loss mitigation funding allocated. At least, maybe it's just Alabama, but we have these ideas that, let's do this, that, or the other to prevent losses next time. And by the time you've finished all the paperwork and it's 3.5, 4 years later, and okay, we got to spend this money. Right now, what were we going to do again, and why were we going to do it? And there's been turnover at the mayor's office, and they're not willing to put the 25% match in. We could speed that up a little bit. I don't mean we, I mean FEMA people in Washington, D.C. I know this isn't, speed and efficiency is not what you're known for, but 3.5 years to fill out a form and get some money back is a long time. And I know that the rules tend to change on the fly as there's turnover in each FEMA division. This is not a terribly hard problem to solve, and it's tens of millions of dollars just in Alabama that we don't get to allocate towards these things. And more so than that is the being able to evaluate these projects, to have a way to evaluate them objectively, as opposed to saying, well, if we had a levee right there, we wouldn't have had that flood. That might not be your best option today, even though that was what happened most recently. So there's a new tool called NCORE that I've been telling people about in side chats, but it's at Colorado State University. They've spent about $25 million developing this over the last 10 years. You can go to their website. It's free. Now, that takes a little bit of a heavy lift. It's not for the faint of nerd to get started, but it does a lot of the same things that the catastrophe models do once you build up your location you want to study. So we're very interested in that. I just learned about it a couple weeks ago and got an account, and we're trying to make that work for us so we can evaluate these. Every single state, every municipality has these projects they'd like to do for mitigation the next time there's a disaster declared, but how do they rank them? This is all very hard to do, and there are some really good tools that people have come up with for doing that.
Thank you, Russ. Your thoughts in terms of challenges and then also opportunities or positive initiatives overcoming those?
I think, again, I mean, I've been a big fan of the education part for insurance companies to get that down to the policyholder, but just interesting hearing about the Northeast. I constantly see portfolios with very high losses, and the models see the risk in the Northeast because there have been those events. We say they're in the tail because they're way high up, like at 1 in 200-year event or 1 in 500-year event, so really higher, less likelihood of it to happen. But as with the last panel, they were talking about how with climate change you might start seeing some of those further north. So the quicker we can get the education to the consumer, then hopefully they can start fortifying and being able to better ride out these types of storms that will inevitably likely come. So.
Thank you all.
Can I say
yes,
one
Natalie,
more point?
please.
Yes, one more plug. And being from New Orleans, it's hard to say this, but Alabama is the gold standard for how, with the Alabama Resiliency Council on how the,
Point at Mark Fowler, don't point at me.
Mr. Mark Fowler and the Alabama Emergency Management Agency work together and sit as co-chairs on this council, because the FEMA money goes to the Emergency Management Agency, and then the insurance commissioner is obviously in charge of the insurance and the risk management. So it is a perfect example, and if you don't have that, you need to have that, even though Alabama Emergency Manager is hoarding the building code money, so.
Thank you.
Cold dead finger.
Let's delve into a little bit of Q&A here in the time that remains. And to get things started, let me ask, what, if anything, can we learn from concepts that have been implemented in other parts of the world? And Superintendent Dwyer, perhaps we could kick that your way to begin with, if you don't mind.
Sure. So the International Association of Insurance Supervisors, which we participate in, every single state in the United States is a member, has a climate task force, of which I was the vice chair. Grace Arnold from Minnesota took over for me last year. But they have a recent paper that they issued. But I spent quite a bit of time listening to people from around the world. The chair was from Singapore, and I'm from Rhode Island. We're 12 hours away. But it's surprisingly similar. I mean, many jurisdictions have these issues. One thing that I think is talked about a lot more internationally than we talk about is parametric insurance. And I think that's because the penetration of insurance is not very high in areas like Indonesia, some of the areas around like Vietnam. So I hear a lot of people talking about, well, parametric insurance for the small farmer who in a typhoon is wiped out and needs the amount to plant the next year. That, to me, is an interesting concept that hasn't really gone that far in the United States, but maybe it could. We have a lot of hurricane deductibles in Rhode Island. It's 5%, up to 5% of coverage A. Nobody is going to expect their $25,000 deductible. Is there a parametric product that could be paired with a regular homeowner's policy so that that risk is a bit mitigated? So there's a lot of interesting concepts around the world, and that's why we continue to participate. We have NAIC staff that do it, and people from the various states to try to pick up some of these ideas and see what is working.
Other places also build better houses.
Like Bermuda.
Bermuda, China. If you live at the coast, it's mandated in a lot of places that you build a house that they don't have to come back and fix. And the complaint I hear is, yeah, but you start doing that now and it'll be 20, 30 years before you ever get any good out of it. Well, we started a little over 10 years ago in Alabama, and now the area where we're about to celebrate our 50,000th fortified home, there's only about 240,000 single-family houses in that area. And that's in 10 years. There's been some development, but it's a substantial percentage of the houses now, just because you've got to start somewhere. Yeah, it might be 2% every year just from naturally re-roofing houses, but if you don't start, you never finish.
Thank you. Natalie, Russ, anything to add here?
I don't have too much on the international front. I know if you want to go into climate risk, we have a global team that is constantly looking in that realm, but in terms of specific projects.
Thank you. We are nearly out of time. I'm going to try and sneak two more Q&A items in here. First, going to innovative distribution models. A member of our audience asks, how do you think innovative distribution models like group purchased cat insurance fit into solving these protection gap challenges? Anyone care to jump in there?
I love this one.
I got nothing.
Well, this is what we call this in insurance nerd speak. This is the Bourse equilibrium. Can we get the right amount of capital deployed to each exposure unit? And the estimates say that we could be 20 to 30% more efficient in the U.S. insurance industry, but you can't make anybody do that because it's everybody making choices in how much they're willing to insure. But yes, the system could be more efficient if it were distributed differently. I'd love to hear a great idea about how to actually make that happen. I've heard of a product called spread strips where you take houses from a lot of different places and you securitize them from the ground up, but you can't write against it as reinsurance. It's more complicated than I have 2 minutes and 12 seconds to go into, but come ask me about it. I think it'd work really well, but I don't know how you implement it.
Thank you, Lars.
I think from the regulator's perspective, there's not a bad idea, as long as the consumer is getting value and we understand how the insurance is being delivered. I think we need new ideas. I mean, people buy homeowners policies because their lender requires them to. That's not the reason you should be buying it. You should be understanding the policy. So is there another way? Is there a group plan that you would value what you're buying? I don't have an answer. I just know that it's probably something we should explore.
We are nearly out of time, so a lightning round question for all here. Looking ahead 5 years, what will the risk-based mitigation and resilience landscape look like? So we're asking you to gaze into the crystal ball. Perhaps we can just head right on down the line and start with you, Superintendent, if you like.
So I haven't mentioned this yet, but we have a lot of risk mitigation tools we use in our financial surveillance of insurers. And we really expect that the insurers are looking at this. So we're looking at it in our risk-focused financial analysis, in our examinations. We expect it in the ORSAs. We expect that insurers, we're more monitoring you. We're a regulator, not a, but we're expecting a lot from the industry in the next 5 years. And we've seen so much in the last 5 years. I can't predict what it's going to be, but I'm excited to see it.
Nothing will change. I don't have any confidence in people.
Ever optimist. I'm not as pessimistic as Lars, but
I'm just neutral.
I think, especially with FEMA, I guess our insurer of last resort, the disaster relief fund keeps bankrupting. We're on our second year in a row. Something has to change, and resilience is it's now a bigger topic every year. So I think we're not going to be we'll be a little bit further than Lars thinks, but something has to change as far as insurance and the way that disaster costs keep rising.
I'll be a bit more optimistic. I think there will be some change. There's definitely been movement, as you can see in Alabama. So, I mean, that's a positive outcome. I think in the modeling firm and trying to quantify the risk, there's been a lot more research and a lot more, we call them secondary modifiers. So some of those, hurricane shutters and things like that, there's more different mitigation factors that they've been looking at that hopefully gets incorporated into models and be able to quantify that.
Thank you. We are out of time. It's been a fascinating conversation. Superintendent Dwyer, Lars Powell, Natalie and Claude, Russell Stack, thank you very much for being with me.
Thank you.
Thank you.
Thank you.
Hello, everyone, again. Good news is I'm supposed to be here this time. I wanted to take just a minute to mention Hartford Innovation Week. I know Kate, my colleague, mentioned it earlier. I'd like to give a shout out to Laura Diane Haber, who spearheaded the idea, the vision of this 2 years ago. It is now running this week with this as an anchor, as one of those 26 events that are happening here in Hartford, all in the base of innovation. So I want to give a round of applause to Laura Diane Haber, who put that together and has been running it now for 2 years. We're up to 26 events. Stacy Brown, thank you again for your efforts in doing the pitch night tomorrow night, InsurTech Hartford being part of there. So that's what I wanted to mention. I am here also to introduce Dan Campany. Dan is an executive committee member and also a CTIFS board of director, and I'm happy to have him here to introduce the next panel.
Good afternoon, everyone, and welcome again, especially to those folks who've traveled here from out of town to be here today. I'm Dan Campany from the Hartford Insurance, where I lead the advancement of predict and prevent risk control capabilities that we offer to our customers to help them manage risk, manage cost of risk, mitigate loss scenarios, and ultimately make the world a safer place to live and work in. This next panel is going to shift gears a little bit and zero in on how transition planning is essential to managing the insurance implications of climate change, vis-a-vis market stability, regulatory compliance, and long-term viability for both insurers and customers. This includes new products, adjusting coverage terms, and maintaining financial resilience. I look forward to hearing these panelists' remarks. I may not be alone in this, but I've spent no insignificant amount of time in the last couple of years debating parametric insurance coverage. Is it insurance or a financial derivative? Is it redundant or additive? Is it customer-centric and equitable? But more importantly, as a citizen and as a father, I care deeply about the societal costs of climate change and the long-term viability and equity of the insurance markets to help us manage it. So with that, to moderate our next panel, let me welcome back to the stage Commissioner Mays.
Thank you all, and welcome everyone to the panel on transition planning and its critical role in addressing the impacts of climate change. We do have an esteemed group of panelists today who will bring a range of perspectives ranging from regulatory insights to innovative industry solutions. But before we go on, I just want to share my appreciation certainly for the regulators who have been here, and especially for Mark Fowler from Alabama. We know that they're facing a natural disaster that's hitting southeast Louisiana, and the commissioner was good enough to make the trip up, and just so you know, he changed his flight so he'd be back earlier to serve his community. So I want to thank you for being here, and I want to wish the best to the people in the southeast who are being affected by this hurricane. So thank you so much. Now, what's transition planning? That's what we're going to discuss here. It's not just about managing risk, but it's about ensuring long-term viability for insurers, regulators, and consumers. Long-term viability, I was actually listening to Director Dwyer speaking earlier as to how long it had been since a storm had affected us. And just so you know, this was actually something I was thinking about earlier too. So I looked it up with the help of my Assistant Deputy, George Bradner. And it turns out the last Category 1 storm to make landfall in Connecticut was almost 40 years ago in 1985, September 27th. And tomorrow, 9/11, will mark the 70th anniversary of the last Category 2 storm to hit Connecticut. It's not just about hurricanes. If you take a look at Irene and Sandy, there were not hurricanes when they hit the coast, when they made landfall here. Yet the damage from each of those was over $1 billion. So we have to manage those risks. We have to have that right balance between the regulatory compliance and innovation. And I think we've got a perfect panel here to discuss it. I'm going to start on my immediate left with Commissioner Ricardo Lara, who is Commissioner of the California insurance, and I think you've got probably the largest single market in insurance in the U.S., and Commissioner Lara has had a tremendous number of issues to deal with in California. California is a huge place, still dealing with it. California is a huge place. We've got everything from earthquakes, we've got landslides, we've got, of course, storms, we've got typhoons, and wildfires. The issues of climate, that climate risk will affect different states differently, as Director Dwyer had mentioned. And California is a prime example of that, although California kind of brings almost everything together. He's done a great job there. Next to him is North Dakota. I'm not sure where North Dakota.
Third largest insurance market in the upper Midwest.
Third largest insurance market in the Dakotas. But Commissioner Gottfried is the Commissioner of the North Dakota Insurance Department, and he is also the President-elect of the National Association of Insurance Commissioners. So next year he will be cleaning up my mess, and I'll be laughing. Thank you, Commissioner.
Already preparing.
Next to Commissioner Gottfried is Rocky Kumar, who's Senior Vice President of Sustainability Solutions and Business Integration at Liberty Mutual. Thank you for joining us. And Lynn Grinsell is Vice President and Head of State Affairs for Government and Regulatory Relations at Zurich, North America. Again, thank you all. Great panel. Please welcome them. I'm going to start with Commissioner Lara with the first question. Commissioner Lara, back when you were in the legislature, you sponsored SB 30, which was the first climate insurance law in the country. And I'm just reading a quote from you here that says, "We cannot deny that with climate change, California faces a threat like never before." So given all that, as we look to transition planning, what would you say are the most important steps that insurers should take to ensure regulatory compliance with transition planning? I mean, we've got lots of regulations. How do they stay ahead of the evolving regulations?
I think, well, first of all, thank you for inviting us to be here. And I also, from California, want to join in the Alabama Love Fest, because they really are, have been at the forefront of all this tremendous good work. And also, putting the microphone here, I'm reliving my, 8th grade in my house, pretending I'm Madonna. So I'm like, thank you for giving me this goal. And I'm also dating myself, too. So, look, for us, we had already been seeing the signs of what climate change was going to do in California. And unfortunately, it's never a dull moment in the West Coast. And as the largest market, we're going to be the first to start seeing, and have been seeing, the significant catastrophes that are going on in the state. And so for us, it was really clear that one, and as we still are working through it, is data becomes critical. Data becomes important on how we measure this risk, how we calculate it, and how do we empower consumers with that data so that they can better understand not only the risk of where they live, but what they can do to mitigate against the potential threat of a landslide, sea level rise, atmospheric rivers, earthquakes, and of course wildfires. As I sit here, there are 8 ongoing wildfires in California, and since June, we're up to 300 wildfires that have prompted some sort of evacuation, and those that haven't, we're close to 300 fires already. And so it becomes more critical for us to work with industry. And in California, for so long, the entrenched interest on both sides prevented the regulator from talking to insurance companies. It was somehow seen as something very negative. We should not be talking to the insurance companies, who are the ones that are the experts that we've been talking about, are the experts around risk assessment, and how do you price this risk. And so what we began quickly with this law is brought world experts together to figure out on several of these climate risks, what do we need to do to better prepare, and what are going to be the factors that we need, both either in regulatory and in the policy area, to better strengthen ourselves and strengthen our market, and then use that as a framework that we can take to other states
and other agencies as well, because as we know, these disasters don't just touch the department. It's about CAL FIRE, CAL OES, and all the other departments that are in charge of protecting lives and keeping this market afloat. And so it's paid back for us in dividends, and where we were able to do the first in the country discounts, premium discounts for homeowners who harden their home. Next, we're gonna do what Alabama and all the other states have been doing. We're gonna start next year with our mitigation hardening program. But the hardest thing was to actually bring everybody out of their silos to come up with what were the standard mitigation features that we needed to do, not only for the individual structure of the home, the perimeter, and for the first time ever, come up with community-wide mitigation standards. Because if the community works together, you bring down the risk for everybody, then insurers keep writing in these communities. And so that's what we were able to do. And additionally, empower constituents or consumers with data. Again, people are not going to want to do the home hardening unless you demonstrate. And unfortunately or fortunately in California, everybody knows the peril that they're living in, because there's not a single day that passes by that there isn't a wildfire on the news or the insurance crisis that we're currently living in. And so don't let, how we say, do not let this this crisis pass by without really taking advantage of it in terms of how we educate around how you mitigate your home. But also, and I'll end with this, we are in a perfect opportunity right now as regulators, as industry, as consumer groups, to actually be creative and be bold and do the things that we need to get done now that we have the attention of our legislators, governor, decision makers, and thought leaders. And so this is an perfect opportunity for all of us to be bold and creative as much as we can within our states and our jurisdictions to make real transformative change that is, for example, in California, has been way long overdue. And so we're not missing the moment. We're actually trying to be as bold as possible now so that we don't repeat these same mistakes that should have been done 30 years ago.
Thank you, Ricardo. And I'm going to ask our technical people if they can put up on screen the Slido, and at some point I'm sure they'll have it up. We're going to be taking questions from the audience via Slido. I know we say we'll do it in the last 10 minutes, but send your questions in. You just scan it, and it's a QR code. You scan the QR code, and there it is. You can ask a question. We'll see your questions come in, and we will start asking the audience questions when we get the chance. So please scan the QR code behind me, and in the meantime, I'm going to go over to Rocky. Rocky, you've heard what Ricardo said, the issue with data, the issue with the fact that sometimes regulators and the regulated entities have often seemed to be working at cross purposes, to not necessarily consider themselves as working together. And you've also heard that this is an opportunity for us to take advantage of the time where we are now. So how do you, as an insurer, react to that? How do you stay abreast of the regulations?
Yeah, so one thing I would say is that when you think of transition planning, it is actually business planning, right? What are we trying to do in transition planning? It's trying to understand where the world's headed, what kind of technology do we have, what kind of policy is there, what are consumers looking for, how is consumer behavior changing. Much of what we do in business planning, of course, this is related to climate or climate-related stuff. So I think if you take that approach, then you're not really waiting for regulation to react to regulation. You're actually getting the work done and developing business-informed actions. And I think where I do agree with Commissioner Lara is that none of us actually have the answers, neither the regulators nor the insurers. We're all learning as we go. And what I've seen in the last few years is actually more communication and sharing of information on what we've learned based on what we're seeing and the perspectives you're bringing to the table. And I think that's really valuable here, because this is going to be a continuously evolving area, and we're not going to get it right the first time, but we will keep trying to, we have the same objectives to mitigate risk, So I think that, to me, that is, if you're waiting for regulation to start the work, it's too late already. You'll always be playing catch up. So that's why thinking of it as a business issue really helps.
And let me ask you, because Zurich, North America, you are in charge of North American relations, but the large European insurers and reinsurers have been somewhat ahead of U.S. insurers and reinsurers on this. How do you see this? How would you address this question? Where are you? Where are we? How do we get to where we need to go?
Yeah, no, thank you. And it's nice to be back in the place I called home for over 20 years, so thank you for inviting me. Well, I think there's a couple of different things. One is that I think regulators need to understand that it's hard for a company that does business in 50 states to be in compliance or to chat with the regulator or have open communication when each state has a different idea of what you should be telling them. So it's hard to come up with some uniformity. It would be great to have that uniformity so that we could just send it over and everyone would be informed at the same time. But I will say that you're correct. We have sort of been a little ahead of the game. We've done TCFD, climate disclosure, for a very long time. We think that insurers should actually operationalize those frameworks so that they're using either TCFD or something like that to make sure that the disclosures are out there. And I know, Commissioner Lara, you've done a lot in that regard. We also, I think insurers should contemplate doing scenario analyses, to explore how changes are impacting their business. Much as what Rocky said, it's like if you're ahead of that and you're doing the analysis, then you can have a more open communication with the regulator about what you're doing.
Commissioner Gottfried, and by the way, for those who do not know, Commissioner Gottfried is in the Guinness Book of World Records for the world's tallest politician.
A lot of hard work went into it, years of growing, Andy. I mean, it's that kind of hard work that you get done to achieve that goal.
That would be fine, except in all the pictures I have to stand next to him, so I look like this little kid next to Commissioner.
You're welcome.
But we heard about uniformity, the difficulty sometimes of dealing with the different jurisdictions. You are the incoming president of the NAIC. How would you respond to that?
Yeah, I think I would push back just a little bit in some areas. I think we've done a good job at the NAIC, adopting the TCFD and kind of going down those roads. But the reality is, I think, looking across our country, the risks are going to be different in different localities, right? I mean, this isn't a Chamber of Commerce pitch for North Dakota, but we're the least forested state in the country. We have 2% forest cover, so it's a great pitch for insurance and wildfire protection, but it's not going to be a tourist attraction. We also don't have hurricanes, so our risks are going to be considerably different than, say, Ricardo's facing or Superintendent Dwyer, and we've got to be able to adapt to that. And so I think through the work at the NAIC, we do a very good job, as much as we possibly can, to reach that uniformity, what makes sense for everybody. And so we can all, again, to me, it comes back to that data. That's where the NAIC has the power, is to be able to bring that data forward. And not to jump too far off the side, but it's something I've been thinking about with the other panels that have come on. And, we're fortunate enough as insurance regulators to look at the whole entire market. If you compare the property market to what we have in the health market, I mean, I can tell you just about down to the citizen how many people had the flu and how many claims have come through, how many prior authorizations have been denied the last month. But I can't tell you really much anything on the property side of the world. And so I think we're in that middle right now where we're getting to that necessity of having that data piece, and whether that's standardization or how that looks, and through the PCMI data call, we're getting there. And I think uniformity comes through that data, right? Once we got a better understanding of what's going on in our marketplaces, we're able to have that better uniformity across our states. And I think, again, that goes back to the power of the NAIC and what we're able to work on as regulators and colleagues. Ricardo and I are very different. He has got Madonna, I've got Garth Brooks. But at the end of the day, I think I understand the risks that Ricardo faces in California. He understands the risks that I'm going to face in North Dakota. And to have the ability for Ricardo to manage his state the way that he feels appropriate versus the way that my state is appropriate to regulate our state, again, that's one of the true benefits of the state-based system, is allowing that flexibility. And I can learn from Ricardo, and Ricardo, I don't know if he's going to learn from me, but he can look at it. And so just to that uniformity piece, I think, is something we often hear, but I think I don't say we often hear it, but it's a strength that we have at the NEIC, and it's continue to work on, and I think that's where the industry can continue to engage in and say, here's a solution that kind of satisfies the data call or data necessities or whatever you have that we can agree upon in all 50 states, versus it feels at times, and I think we've gotten certainly better at it with the communication of not having to pull those answers out, right? Left to our own devices, we're going to come up with some ideas that maybe won't work, but it's that collaboration between industry and regulator.
If I could just give a quick example of why data becomes so important, and an example of why it is critical working with the industry. The first, in the California experience, when we talk about wildfire risk exposure, an insurance company will drop a consumer and say, well, it's because your fire risk score is really high. Yet, we couldn't understand how you got what was the determination of how you got that score. The consumer was never given an opportunity to, maybe that risk was wrong because it was not, it didn't look into the mitigation that was being done. And there was no way to appeal that score. It was just, you were just handed the score, and when we would ask, well, how did you come up with the score? Well, that's proprietary information. We can't give you that. Well, that's not fair. We can't operate in a environment where we get zero data, and then we are having to explain to consumers why you got dropped, right? And so we engaged in a conversation with the industry, and after a year or so, we were able to come up with what we felt was a perfect balance, where we were able to, get the information we needed, be able to communicate that to the consumer, keep it in a way where we weren't gonna, release this data to the world. But now, Californians, when you get your wildfire risk score, you will have an opportunity to call your company. They'll be able to justify that score. You'll have time to mitigate that score and be able to lower your score and actually appeal it if they feel it's incorrect. So in California, the pushback from the industry immediately is, no, it's proprietary information. Well, we cannot advance, and we cannot get out of this, insurance crisis that we're in, and climate crisis, if we just stay in our corners. There's ways of being creative so that we're sharing information, empowering the consumer to do the right thing, which is to mitigate their home, but helping them understand why things are happening. And so I think that's an example of where the regulator industry coming together to empower the consumer to make the right decision, and using insurance to perpetuate good behavior by the consumer. But we have to empower the consumer with the data. The department has to understand so that we are quickly able to react. If we're seeing homes being dropped in a certain community, well, let's go in there and have these conversations now. And the driver of all that, as Commissioner Garfield said, is data.
Lynn, I'm going to turn to you on this one, and I'm going to follow up on the conversation you just triggered with information and data. We're currently, and by we, the NEIC, we've issued the Property Casualty Market Intelligence Data Call, which is the largest data call ever issued by the organization. It's nationwide, looking at the market, more than 80% of the market at a zip code level. So both at the macro level and at the micro level, we can understand the market, we can understand what's driving it, we can understand the emerging risks, and we can see what's missing. Given what we've heard about the importance of data, do you see this as helping drive transition planning, including the creation of new products?
Yeah, I do. One of the things we keep talking about is how we all need to build back better, right? And how we need the data to be able to do that. What's wrong? What needs to exist? What do we need to do to make sure that communities become more resilient? And I think that you can do that either by developing new products, or even in our case, ensuring new construction, new projects, for example. So one of the things, for example, that we do is we ensured the construction of a new global headquarters that was built out of mass timber, right? So while that's not a new product per se, it's certainly encouraging our customers to do something different and to transition into new and cleaner energy, and because of the climate risk that's involved. So I think problem, or not the problem, but I think some of the difficulties is when you go to price all of these new, either a new product or insuring a new project, is all of these are new and we're not sure exactly how to price it. So back to your data, it would be great to have the data for that, because we can't price it without the data. And so I think some insurers are reluctant to jump in to those projects and to those new products because they don't know what it's going to look like at the end of the day. And if we could figure out, you know, if we could have the data to be able to do that, I think we would do that more quickly and respond more quickly. I think of just one thing. I think of like Uber, for example, when we started the ride sharing thing, right? Ride sharing, it was new. We had a product that sort of responded, but we didn't really know how to price it. We didn't know what it was going to look like. How do you price for phase 1, phase 2, phase 3, right? So I think all of these newer technologies with regard to energy or you know, any of the other things that we're talking about here is in the same manner, and data would be awesome.
Let me just throw it to the rest of the panel. Anything to add on that? Data, transition planning, new product development?
I think it's bringing up an interesting conversation of where policymakers lie and where, you know, companies and regulators and consumers lie. And again, speaking from a small state, we've gone through some pretty significant, we're an energy producing state, we're kind of in this discussion on one other side of the coin. But I've had to approach my legislature and say, listen, either we're going to be on the table or we're going to be at the table. And so we've got to look at how do we transition our economy, which is primarily reliant on fossil fuels and agriculture and all those things. And we've taken the approach, and we released it's a STAND report, stand.nd.gov if anybody wants to see it. It's a pretty comprehensive report of the North Dakota economy on how we adapt to a climate-constrained society. And it's forward-thinking. And we're you know, if you want to figure out a way to get a farmer to do something, you show them how there's an incentive there for them to do it. And there's certainly incentives in there to do it. But it's when you again getting back to insurance and building codes and all these other new products, there is a role to play that each community has to play. And I think at least for our state, and maybe not for those who face catastrophes on a more regular basis, but getting that to the point of, listen, insurers don't have to write here. Like, they don't have to cover this community. If we don't have appropriate building codes, if we don't take the steps that we need to take as a community, they don't have to be here. And there's nothing that I can do to make them be here. And so we can either pay for it now or we can pay for it later. And I think that's a discussion that it's finally breaking through a little bit for us when we're having these discussions, but it's certainly a difficult piece.
Sorry, go ahead. I was just going to say, you know, it's very important to understand that there's a misconception where transition is only about the new and the renewable and the future. It's actually about today's economy. It's about current economy. It's about decarbonization. It's about resiliency. So I think we've imported a bit of this European definition of transition planning, which is really about mitigation but not adaptation, and decarbonization. And so I'm very happy that in the US, we've really expanded that definition to include all three lenses. I would say I love to come up with frameworks as to how to think about innovation. And so you have those three areas, but then you also have to understand the drivers that are driving the change in these three areas. And that transition comes from different or changing policy, changing technology, and changing market behavior. So an example of, it may sound very boring, but an example of innovation that we had at Liberty is a tax. In 2021, there was a tax credit given for capturing carbon dioxide for certain industries and then permanently storing it in the ground. And we came up with a product that allowed for ecological, it's an environmental product that came up with site pollution liability and environmental protection. That's an example of supporting today's economy, right? So I think that's something we need to think about when we think about innovation and transition planning.
And I think although, as we talk about transition, is using insurance to incentivize good behavior and throughout the entire transition process. You know, for us in California, everything's on the table. Microinsurance, inclusive insurance products, parametric, And for us, we see parametric as an important piece of a bigger puzzle, but also how can we use parametric, let's say example for flood, and for those, just for a baseline coverage so that everybody in that community has access to be able to find shelter. New York has done something similar around low-income seniors and flooding. But also, what about if embedded in this parametric product, you incentivize insurers to actually help on the mitigation piece in the front end so that we're not, and that we're prioritizing nature-based solutions. So we're not just creating gray infrastructure, which is a lot what you see as we're talking about Holland, that is much more costly, unsightly, and that if we invest in mangroves, if we invest in sand dunes that are naturally been there to protect us from extreme weather, knowing that the city or the community can't do the full restoration themselves, but how do we incentivize the insurance company to actually help on the mitigation piece so that they're not paying out the larger claims on the back end? And so those are kind of the things that we're working on in terms in California of how do we incentivize on the mitigation piece for these parametric products around extreme heat, sea level rise, flooding, and wildfire. And then on the technology side, you know, the ports of Long Beach and Los Angeles that I represented in the state Senate, 40% of all the goods that come from the Pacific Rim come through those ports into every single congressional district in the United States. Now, the amount of pollution, we set some goals that we want 300,000 electric trucks by 2029, in particular in the ports. And that gets to the point you were mentioning around, these are new technologies. How do we price these? How do you price the technology within the truck and the actual hardware of the truck? How many miles are those trucks going to drive? And particularly the drayage trucks that are the short haul, you know, diesel run. And so we are trying now as the department and in the legislature, how do we incentivize insurance companies to actually start providing policies for these type of technologies? So again, as we've seen in California, whether it's any groundbreaking environmental policy, it takes a partnership with the specific industry, with heavily subsidized by the taxpayer in the beginning as they mature, as we are going to now invest in these different type of parametric products. Because if you've seen what Puerto Rico's done around the coral reef, Hawaii has just done the similar thing around the coral reefs. That is a partnership between government, the insurance industry, and nonprofits. So I think that's going to be the key to start a lot of this innovation that will ultimately help in transitioning as these products mature, similar to like the solar industry, for example.
I'm going to come back to you on parametric. Let me switch not topics, but switch lanes just for a minute. Rocky, I'm looking at you. And I have an audience question here for you. Or I had an audience question. It says, what are some of the major obstacles insurers face when developing new products or adjusting coverage terms in response to climate change, and how can they be overcome?
Yeah, I mean, I think you mentioned it, Lynn, about data, history, right? We always use history and pricing data and risk. And then sometimes these risks are new types of risks, right? These new technologies are new types of risks. I think another challenge we've seen is sometimes everything gets funded and insurance is an afterthought. They come to us after everything is done and say, here's what we want. And we're like, well, if you've done this in the design phase or this in this phase, you don't particularly need that much, or you could have mitigated some risks. So I do feel that in the transition, we also need to think about the role of the insurer and bringing the insurer, instead of, I come from investments, and when I first came, my colleague, he told me, oh, you've come to the stepchild of sustainable finance insurance, right? So that's an example where we now are starting to become the favored child because they recognize the role that insurance can play as an advisor.
Anyone else?
Yeah, I would like to respond. So there's a couple of different things. There's a soft, if you will, a soft process. And that is creating a culture within your insurance company to actually encourage your customers, the this is an important thing to do. Because it's not easy. And the more you get your employees to buy into the fact that, you may know that Zurich wants to be net zero by 2050. So the more that you get your employees to buy into that, the more that they're going to talk to the customers about it and to encourage them to transition, right? So you got that. But then I think I think that some of the biggest problems is that we depend on the government, all government, all policymakers, to establish supportive policies, to establish the ability to have public-private partnerships, to actually make sure that mitigation happens, to make sure that people understand that it's a community, it needs to be a community involvement in this, that it can't just be, it just can't be one house, one person, it has to be an entire community. And if we had more supportive policies, I think that insurers might, we're all in, but I think more insurers might jump into that, to that process.
Just jump in on one piece. I think, I don't disagree with you on the need for supportive government policy. I think for the longest time, for probably the first, well, maybe the last 100 years, there was a disincentive in policy to support mitigation, right? I mean, you think of the rebating laws in the United States that exist around insurance, and so I know Superintendent Dwyer was very involved in the updating of the anti-rebating laws. It's one area where I think policymakers have taken a step. I don't know if my state has updated them, some states haven't. I'm hoping California has or will. But that's where, again, I think we're another role to try to incentivize insurers to operate in that space in a competitive place.
Right.
To say, okay, the easiest one is the leak detection piece. We'll give you the hockey puck you put by your washer and dryer for free. Before, that was illegal. That was an undue incentive. And so rethinking some of those pieces, I think we're still at the beginning of doing that, but there is an absolute critical role to, Commissioner Lara said, of insurers playing in this mitigation space, because they're going to know that best, right? And I think it goes back to the data piece too. I can't believe that you'd be denied a wildfire coverage and said, well, we can't tell you why.
Right.
It's like, well, how am I supposed to fix it? And so again, that's where that convergence comes of data, insurers, and regulators, make sure that we can operate in that space and remove some of these antiquated restrictions that prevented or disincentivized that mitigation, the very mitigation we're looking for.
And I think what Lynn is saying is really important. And I'll tell you, in the largest market in the country,
we get it. You're big.
No, even
After North Dakota.
After North Dakota.
Right on the heels, nipping there, right there.
I'm just saying, because even of a market of our size, seems to be, and it's changing, a disconnect from the European parent companies with the domestics. We constantly have to point to what the Europeans have been doing in terms of TCFD, of investing in these new products, and it seems like the domestics are just at a wait and see. Like, well, let's just see what comes out of that. And this is why it forces us, the regulator, to be much more aggressive when it could have been much more collaborative since the beginning.
A couple of questions here for regulators from the audience. And well, I'm going to start off with the regulators. One has to do with the mitigations that we've been focused on. It's been focused on property casualty companies in order to address climate-related risks. But personally, I still remember our first C4I a few years ago during COVID, and the Yale Center for Climate Change, the leader of that was one of the speakers, and she reminded us that it's not just about property casualty issues. There are health issues. There are life issues. Now, how should life insurers, for instance, this is an audience member would like to know, how should a life insurer think about addressing these risks?
So I'll say a real life experience we're trying to tackle on now is this issue around extreme heat. And our department a couple years ago passed legislation that's going to require, and by 2025, to actually start ranking extreme heat events like storms and hurricanes. So it's no longer just a weather story. It's like shelter in place or seek shelter, turn on your air conditioning. Some people can't afford to do that, or also, go to your hospital, make sure you keep your medication cool. And so along with that, we, in the legislation, we put in some money for the first ever study around extreme heat for insured and uninsured losses. And what we've seen is the tremendous impacts that extreme heat has on life insurance policies and on our healthcare policies, even on infrastructure, not just talking PNC, but like just regular infrastructure of where people can seek shelter. And so we just came up with the report. We'll make it available, but it's in the billions of dollars of the amount of loss to not only the insured piece, but the uninsured piece, particularly to life and health insurance policies. And so we are just on the cusp of further doing research, and it's a reminder that extreme heat is what actually kills more people than any other climactic event that we've experienced.
I would just add a little bit. I think it's extreme heat and extreme cold too, right? I mean, and so we deal with that in North Dakota. We deal with the, and so we have structures in place for that. But again, it's because we've had that for centuries, right? And so I think some of this is, again, getting back to that new wave and having to transition into whatever this looks like. Like our infrastructure in North Dakota is built to withstand 60, 70 below zero, right? You can't go outside at that time. Kids are inside, schools are shut down, all these things, and so I can see that very much happening on the other side of the coin too. It's a fact of life for us in North Dakota on the cold side, and I can see it becoming.
Mr. Godfrey, if you're like everybody else who's an insurance regulator, you get yelled at when home insurance or auto insurance rates go up. It's back to life. Doesn't really matter whether or not you're responsible.
Right.
No, we have an audience member asking, what steps do you take in balancing your role of working with insurers, knowing that you have to protect their solvency, and with consumers to make sure that insurance is as available and affordable as possible?
Did my staff write that question?
I mean, it's a balancing act, right? We do it every day. It's part of the job that we signed up for, I think, is how do you balance these interests? We've taken the approach of trying to clearly explain to our consumers kind of what's going on, and I'm fortunate. I think we've got in our state, 90% of the people that I talk to, after you get over the initial shock of why am I up 40%, why I can't believe this, what are you doing, John, to do this? And it's like, well, have you shopped around? Well, no, I've been with the same agent for 30 years, and I don't want to leave Ricardo. Right. It's like, well, Ricardo may not be giving you the best deal.
Right.
And so let's go look around a little bit. Ricardo gets to look at a sliver of the pie, and let's look at the whole pie. That seemed to alleviate some things. We've also undertaken a North Dakota insurance initiative that I can talk about with our consumers. Like, listen, we're trying to adapt to it. We're trying to figure out what levers can we pull at the state level to help incentivize more capital in our marketplace, which would hopefully bring down rates for you. None of that is going to fix the rate. They're still going to write the check to pay for their insurance. They're still going to pay for that insurance. So, but again, it goes back to what this whole conference has been about, I think, is educating the consumers. I think we're at a point now where consumers are probably more knowledgeable of their homeowners policies, their property policies than probably ever before. And we've got to take advantage of that. We've got to stay in that space, right? As this hopefully passes, as the hard market softens, as things kind of hopefully come back to a more quote-unquote normal, we need to have these consumers continue to be engaged in their products, because one, that'll give them tools to mitigate their risks. Two, will hopefully help keep the markets healthy and stable. But again, an informed consumer is always a good consumer, and just sitting down and talking to them, it's not a fun conversation. I don't like it. I'm sure you don't like it. Nobody loves to be told that there's nothing really we can do, and that we're part of a global market, and this is just kind of the way it is right now.
Ricardo, is there anything you?
Absolutely. We live this every day, balancing both. And even in my own department, I have to remind my team that I am also responsible to keep the market solvent, right? And even in my own talking points, when what about the market solvency? We have dispersed I didn't overcomplicate this. We doubled down on creating an outreach department in the department. We have been to all 58 counties in California, and we continue to do so. And just talking one-on-one, what I realize are people are really scared, especially people that have lost their home to to any disaster, and I realized that we need to really double down on mental health services, because after you lose everything in a fire, and then you're being asked to sign financial documents, it is the most difficult thing to ask anybody to do, and I almost think it's cruel. But once you have the conversation in a way, we go back to data, and I'm able to demonstrate, no, insurance companies are not making record amount of profits, and here is the data showing you. And we all can understand what's happening with the wildfires. And when I talk to somebody at a town hall, 500, 600 people, because it gets packed, people are wanting to understand, and I tell them, we're never going to get to affordability if we don't get to availability. We need insurers to be writing back. And the one thing that I think is the biggest level setter of all, people that have dealt with the National Flood Insurance Program, is nobody wants government running an insurance company. And that's what I start with, the number one thing. Do you want government to run an insurance company? Hell no. Okay, well, let's talk about how we bring down the risk and get insurers writing back into your community. That's where we have the power. We have the power to bring down the risk, and we do that through all the community, the mitigation programs that we're seeing. But I think it's having that dialogue, and people, and also taking away the uncertainty that they're going to lose their coverage in the following year. Because they're like, that's what scares them the most, is not being insured. And so if we work together through, again, the agent you're using is oversaturated in that area, call us, or you're probably using a broker that already has. The other thing is, the hardest thing for me to explain is, I've never had a fire, my community's never had a fire, why am I being dropped? And you're having to explain how we want insurance companies to be able to democratize their portfolio, so that if you may be dropped, they can keep a home that's in a higher risk. And that's constantly our job. So we help them find coverage somewhere else. And also the thing is, just to end this, is that people tend to go to the top 5 insurance companies that are the ones on TV constantly, or that have now our former governor as a spokesperson. And so reminding them that there's hundreds of other insurance companies that are small, medium, that are writing policies now. So it's constant education. And I'll tell you, 90% of the times when I leave those town halls, people are very content that they understand the market, and they understand that we're never going to get to affordability unless we get insurers writing back into your community, and that's what we're working on.
Lynn, got a question for you, because you mentioned Uber. And I remember way back when, former New York worker, taxis were always there. And I knew people who had taxi medallions that were up to 1.3 million, I recall. And after Uber came in, it was down to probably 300 grand for a medallion. Lots of people went bankrupt. Doesn't mean that it wasn't a good for everyone in general. But that's also part of the issue with transition planning. It does come with significant obstacles. It comes with financial constraints. It comes with resistance to change. We heard Ricardo mention parametric products. I don't think there are too many regulators who haven't heard the complaint that that's not insurance, that's a derivative. We're not going to do that. You know, from your point of view, and I know I had a question here that led me down, that I was thinking about this. The question from the audience was, how can insurers and regulators work better together to make sure that the transition plans not only meet regulations, but also encourage the kind of climate innovation that we need?
That's a great question, and I think we can all do a lot in that regard. So education's the key, and I think we would all agree with that. You got to educate the policyholders and the communities and everyone about mitigation and how, if they do what they need, and I've heard this in panels today, if you do what you need to do now, you're gonna, it's gonna be helpful later. But I also think that at least at Zurich, you have to do as well. So, for example, we have what we call Zurich Risk Solutions. And Zurich Risk Solutions, we're all in the risk management business. We actually go out to our customers and we try to educate them on what technologies they could use, how can they build back better, just all the things that they could possibly do to create a better risk, so that their premiums may go down, their claims certainly are going to be less. And we make it a point of actually just going to all of our customers to do that. I think we can also be involved in public-private partnerships, as I stated earlier. We're involved in a project called Resilience for Cities. We teamed up with Resilient Cities Network. We're working in Boston and Houston to actually find the communities that need the most help in mitigation and resilience. We worked with them with the data to figure out what those projects needed to be. The best part about it is that we actually went to the communities that needed help the most. So I think I heard earlier today, some communities can build back better without any issue, but there are some communities that are too poor to do so. So we wanted to make sure that we hit those communities so that they would get the help that they needed. But again, like I said, it's about helping, it's about educating, and it's about doing, and actually doing the work that you say that you're going to do.
Okay.
Yeah, so much like Zurich, we've also really leaned in to help inform our retail investors about how to mitigate, how to create resiliency. So we have it's a very successful launch for us. It was a test pilot called Weather Ready, where you could go put in your zip code and you could tell them if you're updating or you're rebuilding or any such thing. And we partnered with IBHS to give their building standards, how to build back, etc. And it's really been so successful. Now it's on our main platform for all our customers and in 9 different states. So and not only do we give them the information, which is IBHS informed, but it's also connecting them to various vendors who can help them actually execute. So that's an example where I think for retail customers, it's been very informative. And then now we're at a point where we're trying to adapt that tool for communities, because we've talked earlier today about how it's not just about individual resiliency, but it's community resiliency that is needed. So it's pretty much similar to what you guys are doing too.
Unfortunately, this has turned red, which means I'm out of time, but I do want to thank all our panelists for sharing their insight. This was really informative. I want to thank all those in the audience, especially those who sent in questions. Apologies, we couldn't. You'd sent in lots of questions. Great participation. We couldn't get to all of them, but I will get you John Godfrey's email address so you can send them.
Happy to answer.
Send them all to him.
But thank you all.
Great. Thank you so much to our panel. Really such wonderful insights. Just briefly, I'm Ann Tebow, and I'm pleased to be the co-chair of CTIFS with Susan Winkler. And we are so grateful to be now in our 21st year bringing together the insurance and financial services companies within this region. And you see the power of bringing together business along with regulators to have this dialogue and to foster the types of ideas that we're discussing today. Part of our focus includes thought leadership, and I'm really pleased to share with you that the latest Connecticut Insurance Brief, Insights Brief, is available, and you'll be able to get a copy of that outside as well as through our website. But we are so grateful to our partners with Conning for producing this for us this year. It's a way that we're able to capture all the goodness that happens in this region with this industry. And just a couple of insights I'll share just briefly. We are proud of our heritage in the insurance industry in this state, and we lead the nation in terms of the number of employees that are employed by an insurance company across our broader employer base. We lead the nation in terms of our contribution on a percentage basis to our gross state product, with over $21 billion being generated from the insurance industry in Connecticut. And we employ the highest number of actuaries across the country, with 1,300 of them, and I have one that I live with in my house, so we have lots of spreadsheets. But that really speaks to
the power that we have with our CTIFS, and many of my colleagues are here today, where we are able to continue to amplify the meaning of that for our region, for our industry, and continued growth. So we really do appreciate all of you being with us here today to continue that dialogue. And with that, I know you're all antsy for a break, so you have till 4 o'clock. So thank you for joining us.
Please welcome Courtney Larkin, Vice President, Government Relations, Travelers.
Hello, and welcome back. My name is Courtney Larkin. I am Vice President of Government Relations at Travelers. And I want to thank everyone who traveled here today. If you came on our highways, you may have noticed we have new signs welcoming people to Connecticut. And although they're exciting, I told Commissioner Dan O'Keefe, Commissioner Mays, that they forgot one sign, and that was the insurance capital of the world, which we are very proud to be. So I thought I'd just take a moment to remind everyone why we're the insurance capital of the world. Travelers was founded in 1863. The Hartford was founded in 1810. Aetna was founded in 1853. And the Phoenix, now Nassau Re, was founded in 1851, all in Hartford. These companies were the first to offer accident insurance, auto insurance, workers' compensation. The Hartford insured Abraham Lincoln's only house. The Phoenix insured Abraham Lincoln's life. All these companies were involved in the recovery efforts after the Chicago fire in 1871, the San Francisco earthquake and fire in 1906, and they all either insured or bonded the Hoover Dam, the Golden Gate Bridge, the lives of the original 7 astronauts in '63, and the first lunar flight in '69. As a lifelong resident of Connecticut, I'm very proud of all these moments. I'm also proud that today this conference proves that the state and our industry are still the leaders on the pressing issues of today and the needs of tomorrow. With that, I'm happy to call our 4th and final panel to the stage to talk about the climate and insurance, the risks and the social good.
Wow. Well, good afternoon. Thank you all for sticking around this afternoon. My name is Tim Queen. I'm the Global Head of Insurance Consulting for Cognizant. And it kind of struck me walking out here just a moment ago as I heard again the repeat of the Hartford being the insurance capital of the world. It's just interesting to me, and I'm glad there is that partnership with the UK side as represented on this panel today, because I'm sure there are some heads turning on Lime Street about now too, about hearing, isn't it Lloyd's? Is it in the London market? Along those lines as well. So a good competitive nature, if you will. But I'm really glad you're able to spend some time with us this afternoon. I have a great panel here that I'm very fortunate to actually be spending some time up here. And beginning on my left over here, we have Regavir, who is the head of Climate Insights and Advisory at Munich Re, American. Then we have Jonathan Jackson, hailing all the way over across the pond from the UK. He's the CEO and co-founder of Prevesico, which is focused on advancing technologies that enable flood resilience for people and organizations. And last but absolutely not least, Eric Nelson, Senior Vice President for Enterprise Catastrophe Risk Management here at Travelers here at Hartford. So, we're going to begin today, Regavir, with considering just a topical question off the top for you. As we talk about the major impacts, the frequency and severity of the storms that we've been seeing in the marketplace, I wonder if you can share some of your views on what impacts it's been having within the reinsurance market itself.
Sure, thank you, and good afternoon, everyone. Now we are the last panel, so hopefully we'll make it smooth here. I think that's a really hot topic, so but I also like to introduce myself as a displaced hydrologist, right? So we're thinking about floods all the time. So within that perspective, I'd like to give some numbers, and I'll start with the numbers because that really gives a perspective. And so last year, 2023, the severe convective storms in the United States created insured losses of 65 plus $billion. So that kind of gives you a sense of what the insurance and the reinsurance industry collectively paid for the losses that were incurred. Another number that kind of sits in terms of what is an opportunity, but also a kind of addressing some of the climate risk, goes towards the peril of flood. And that was in 2019. Now, all the years, floods do impact a lot of communities, even this year, last year. But 2019 was different because this impacted the central Midwest United States, which is the Mississippi River. It was one of the historic flooding, and the total losses economic losses exceeded 25 plus $billion. But over there, what we saw that the insured losses was less than 200 million. So basically, less than 1% was really insured. And this is the heart of America, and this is where a lot of like agriculture, tourism, a lot of things, a lot of industries exist. So it did impact people's life quite a bit. And note that the pandemic followed that big event. So, so when it comes to the frequency and severity, we start looking at these events and we say, right, what's really missing? And let's get back to the fundamentals. And if we think of risk as a function of exposure, vulnerability, and the hazard, we know that the hazard is changing, and that is something that is not in our control. At least, even if we take all of the emissions and control them today, that's not going to change the weather and the hazard of today. Or at least in the next 10 years, it won't change. So what's really can be changed is vulnerability. We can build back better. I think the previous panels talked about that. And then the exposure is really, it matters because we have seen after the pandemic, there was a lot of change in exposure, increase in exposure in certain states. So with that in perspective, what we want to go back to the fundamentals is the risk transfer continuum, what we call it. And risk transfer continuum says that if we really want a sustainable insurance, reinsurance market, then what we want to think about is risk assessment and risk communication becomes the top of the list. We really need to understand our risk, at least in the coming years, and because that is what will drive the decision making that we will be making in terms of the exposure changes, in terms of the building codes and so on. And then comes the risk management and the mitigation part. So that's the next important point. And then we can come to a product of risk transfer that fits the needs of the communities and the products. So I'll stop there, but I think that's how we are really thinking about this as the frequency and severity changes.
That's very interesting, and as you say, going back to the fundamentals underscores it all, right? Remembering where we came from, but going back to not losing that root. And so, Eric, from your perspective, from a primary insurer standpoint, how would you actually view some of the things that you spoke about here today, and from your position, how do you see it differently or the same?
So let me just start with building upon the discussion that we had earlier. You know, insurance companies here, we're here to spread risk over people and over time and help communities recover. We talked about that earlier. One of the other aspects that we really lose sight of sometimes is we provide a risk signal to consumers. I'm going to say something controversial. Risk rating 2.0, I think, was very good in that it sends more accurate risk signal to consumers. So you think about, for years, we had such massive subsidies in the flood program that perhaps where we developed wouldn't have happened if they actually had to pay the true costs of flood risk. And as a country, we're now paying that price because we've developed really where we shouldn't have developed. And so that's a key aspect. When you can have risk-adjusted rates, it sends a signal to consumers on what that risk is. And let me just give an example. You know, everyone knows that if you have a doctor in the family, they always ask advice, or a friend. Well, if you're in the insurance industry, your friends ask you advice. And my friend was buying a house in South Florida, a modest house. And I said, boy, before you decide on that contract, you go get a flood insurance quote. And he said, wow, it was $10,000 for that 1,500 square foot house. Didn't buy the house. He said, that's way too much to pay for insurance. And I said, I knew that. You're in the highest risk area of South Florida, a quarter-mile from the beach. Of course it's going to be expensive, but that's a risk signal. So with that, I just want to also just talk about loss trends for a minute. This is a great conference. We're talking about climate, but I want to make sure that we talk about beyond why losses are up. We have to make sure we understand weather contributes to the loss trends we're seeing. It is not the primary driver. I'm sorry to say that. Inflation is the primary driver of why losses are up in the United States over the last 5 years. It's inflation. You probably have all seen housing prices go up dramatically. Well, if housing prices are up 50%, insurance is up at least 50%. And so inflation is the #1 driver. In addition to that, what might not be common knowledge is supply chain, everything else post the pandemic. Roofing inflation is dramatically higher than general inflation. And so IBHS talked earlier today about insurance. It's all about the roof. It starts with a roof. So beyond that, there's other factors that come into play here. Urbanization. As you have more people in a concentrated area, it's a bigger bullseye. You also have, in some cases, contractor fraud. I know the states have some great programs to get at that, but we've seen that. We've seen contractor fraud in certain states. And then legal environment. Florida's an example of a legal environment where legal costs have spiked for catastrophe claims. They've taken action now, but that's one of the reasons why losses were up in Florida. So I just want to make sure we all understand the weather is important to understand and really to devise your strategies, and we'll talk about that more, but inflation is a challenge today. Thank you.
Yeah, great points. And you know, I never thought about it, but in 1985, I was a kid growing up in Long Island, New York, just across the sound from here, and it was Hurricane Gloria that came through as a Category 1, which eventually then also hit Connecticut. But I think the total loss on that was around $900 million. But if you go to 2023 and you look at just a storm, a really persistent storm over Fort Lauderdale was about $1 billion worth of loss in and of itself, right? So, Jonathan, you heard what Eric had to say, and you're coming from a different perspective, right? You're coming from one that's related, but you're looking at innovation. How do we solve the tough challenges that are ahead of us? And I was just curious about, maybe you can share with the group here just what your perspective is and what you're seeing from a market about innovation and the sort of tooling that's being brought to bear to help us address these issues.
Yeah, thanks. I've got a different accent and I've got a bit of a different perspective on this as well. So I guess where we come from, you know, we are in the world of providing flood risk warnings. So effectively we're providing a service which enables people to have an advance warning of flood so they can take action to prevent loss. So governments provide warnings for main river and coastal flood. We kind of fill the gaps in the government warnings. So just to give a bit of context about kind of where I come from. So Gavir's points about communication, you know, that plays right to the heart of kind of what we do, because fundamentally, as we're hearing from Eric as well, you know, people have to understand risk. Well, one of the ways you understand risk is you communicate it to them, and getting risk across is really key. And I think that, you know, it's a lot of things that are being discussed today, and again, picking up from what Gavir was saying, is that the way that flood as a risk is changing is really getting quite dramatic now. And I had a great example when I was in Wilton, Connecticut yesterday, and I met with a large manufacturer there, and I also met with the deputy fire chief of Wilton. And we were talking about the flood that had occurred at this particular location of this manufacturing plant. And the fact is they'd had risk engineers come in, do a fantastic risk assessment, said this is where your flood problem is coming from, this is where you need to protect against. Flood hit the particular location that they had identified, which was a culvert, no problems at all. It was in a completely different side of the plant. And talking about why that was, it was down to the fact everybody felt that this particular storm had come in and literally sat over the town for 7 hours. So they had 8 inches of flood water for 7 hours. And they said previously, convective storms tend to go through pretty quickly, but this just stuck there. And so that was a very different experience than they'd ever had before. So as from a risk engineering point of view, the risk engineer's thinking, I'm basing this on what I know, but unfortunately, what we know to me, is a lag indicator. It tells you where the risk was, but it's not necessarily telling you where the risk is going to be in the future. And I think that's a really big issue. The other thing that really struck me was when I was talking to them as well was we were talking about the town of Oxford, and it turns out that the town of Oxford had what was considered to be a 1 in 1,000 year flood event. And so, again, the deputy fire chief was saying to me, he said last time something like that happened was in 1955 when Hurricane Diane hit. So I said, was that a 1 in 1,000 year event as well? He said, yeah. And I think that sums up one of the big problems that the industry faces, is stop talking like that because it's completely meaningless to people. They have no idea if you're telling them they've got a 1 in 1,000 year event, yet one's happened within less than 100 years. It's a really complex area, but fundamentally there's a lot of things that we have to look at to help better communicate the risk that they face with flood.
Yeah, so Eric, as Jonathan was talking through that, it came to mind, of course, another, I think, third rail for you would be around this idea around secondary perils, right? Concept, the fact that something that's trailing this larger event, but at the same time, too, just thinking about just singular events. There's a lot of nomenclature, a lot of language around categorizing these as being different, right? But we look at the economic and the people impact. It seems to be really not all that different than what we used to look at from just hurricane or tropical storm, if you will. So I'm curious for your perspective specifically around what sort of changes we need to have around this topic of these categorizations. From where you sit, is that language helpful, hurtful, and what do you see as being maybe a change that needs to occur?
Yeah, we need to talk better terms. If a consumer has been hit by the roof blowing off their house and it's a secondary peril in the news, no, it's not. There is no such thing as a secondary peril. We have to end that conversation in the United States. If you look at severe convective storms, so that's winds, tornadoes, hail, the last 30 years, the insurance industry has paid out more for that peril than any other peril, more than hurricanes, more than earthquakes. It is by far the largest peril that we have to deal with. The message has to be that everyone in America is exposed to high winds at some point. And I think that's the key challenge. And let me move over to flood, because I think I listened to Superintendent Dwyer this morning, and I completely agree with her. The way we describe storm surge and flood damage and the way we describe things is wrong. That the banks go, because it's a federal requirement, and they basically say you only need flood insurance if you live in a high-risk zone, is the wrong message. Years ago, we worked with Wharton, and Wharton talked about effective risk communication. It would be much better if in the home disclosure package you said instead, you have a 30% chance of having a major flood damage in your house over the life of the mortgage, or 40% or a 50%. That would cause consumers to more likely to choose to buy flood insurance on an optional basis. So as we talk about risk, we have to stop categorizing these to the 1,000-year event, that it's a secondary peril. You have to really disclose people, give them more information. I think the last commissioner panel talked about enabling the consumers to understand risk better, and that's what I think we need to do.
So, Raghav, you've heard Eric's comments along those those lines from a reinsurer's perspective? Any differences, nuances, and especially being a frustrated hydrologist being caught inside the insurance industry. Just wondering if you have any comments more specific to that.
True. But I think I also wanted to add one point, what Jonathan brought up, and the concept of risk is something that that needs to change. How many times have we heard someone saying, in my 35 years of experience, I haven't seen this event. Not to go into too much details, but recently I went to New Mexico for a backpacking trip, and we were hit by with Scouting America, and we were hit by a hailstorm, and the group decided that they want to keep going, right? And they ended up hiking in hail for 1 hour, right? And a couple of hypothermic situations and all of that. And then at the end of it, we hear, in my 35 years of backpacking experience, this has not happened. In my 10 years of experience, it has not happened. So the concept of risk needs to change, where we, of course, past can give a sense of what can happen, but the future uncertainty also needs to be factored in. And I think that's what the industry is also, has a long way to go, but also we have been putting a lot of work and a lot of resources into kind of addressing that assessment and communication of that risk. So having said that, to come to that point, I think, yes, as a frustrated hydrologist, these are terms that keep on coming, but I think we are addressing, as a reinsurance industry, we like to think of it as a reinsurer. At least my personal view is we are like a sonar scanner. We like try to look into the future and say, all right, what signals are we getting, right? And if the risk is really increasing, how do we see certain products, what kind of products do we need? And so that's the thinking that we are trying to change. And one of the things as a reinsurer, we realize that we do not have a seat at the table at the local communities. We did not, at least in the past. But now we are starting to work with the local communities, because in the United States, the amazing thing is the local communities are empowered to manage their risk. But that's great. However, as an industry, between the insurance regulators, the commissioners, and the industry, the risk is being managed by someone else. So we have to have a seat at the table and try to communicate the risk, but also create solutions that are more tailor-made to the needs of the community. And especially for perils like flood and wildfire, we have to start thinking in a different way. How does risk mitigation at a community level get factored into the insurance products of the future? Again, our view is a sustainable insurance market needs constant innovation, which is what you are focusing on, Jonathan. And that requires innovation at all fronts of the risk transfer continuum that I mentioned.
Very good. That was a nice tee up to you, Jonathan.
It was. I was realizing as well, I should have taken you to Wilton with me yesterday, Raghavir, because I needed a hydrologist on that site, believe me. I think that everything you just said there absolutely resonates. I mean, fundamentally, if I look at where things are right now, one of the things that we probably would say is our most successful achievement as a business to date is actually at a community level. And it's a little story I'll share, which is that in the UK there's a community that lost about 300 homes and businesses to a flood. And it was all caused by the fact that they have a culvert, and storm comes in, brings down debris, builds up against the trash screen on the culvert, and causes massive flood. So what we realized was that actually, if we just put one of our sensors there, along with our flood forecast, we were able to give the flood warden in the village advanced warning of flood. And her resilience measure, because the other thing too, I think, is again, descriptions, as we were talking about. So resilience measures, people think very expensive. The the resilience measure in this community is she takes a rake, she goes down, and she rakes off all the debris from the trash screen. She has successfully mitigated 100% of flood loss on 8 different occasions in the space of 3 years. So I think that plays exactly to what Raghav is saying, is that there's sometimes there can be some really simple and easy wins out there. But again, unless the industry, unless the data comes back again, it comes back to this point about data, people understanding that, insurers, they don't know about this, so unless that comes back, that's a really key area. So this community level side to me is one of the areas that we as a business really want to focus on. Where we are at the moment is that we tend to work with large organizations. So another one we work with is a company called National Grid, who some of you may be familiar with. They a power utility who operates in New York State and Massachusetts. And kind of with those guys, we're placing sensors at various sites, and again have our forecast working as well. And what we've realized is that, you know, in the same way as in the village, the community in the UK I mentioned, is that where we put our service in with a sensor, we can potentially be covering thousands of properties. Well, we've just got one client who's using it for one asset, one property, yet there's thousands of people who could benefit from that. So how do you then take that out? And, you know, a power company obviously is a key part of the community, so we're looking at ways in which we can work with them to actually extend that service across the community to get the service out to more people. And so for me, that's great that we can do that, but then it comes back to the next point, which is you give somebody a warning that they're going to get flooded in the next few hours. You better make sure they know what to do, because otherwise all you're going to do is cause panic. And so that's the next critical element for me, is actually what do you do with that information, and how do you try to mitigate the losses that come about from that. And again, sometimes it can be really, really simple stuff. You know, some of the most basic things are just turning off your gas, turning off electricity, and turning off your water supply, and that can save an awful lot. But we now know of businesses, there's a great example we have of a bookshop who, when they were being flooded in the past, they couldn't resume business for 6 months. So 6 months of business interruption, couldn't get insurance, so that forced them into then investing in various measures, resilience measures, which were often very simple things like raising electrical sockets higher up the walls, thinking about actually where their shelves were for the books and actually again raising those up, etc. And they are now in a situation where they are able to reopen the shop within 3 days of having a major flood. So what used to take them 6 months now takes them 3 days. And again, the impact from the insurance side is really significant. They can now get insurance because all of a sudden that is a much more writable risk for any insurer to take on board.
It's interesting, as you were talking about the community and communication. I now live and have for 25 years in Northeast Florida, and we had a hurricane that came through. Actually, it was not. Again, it was one of these smaller storms, less impactful, but it did flood 1,000 homes in our county. And principally, the reason for that was these clogged storm drains themselves. And I think it's definitely overlooked. And so those types of solutions can be very impactful. But also remind me too, that earlier today we were talking about where is the younger generation concerned about insurance? Do they really have a care or concern? And it's kind of an unfortunate story, but I would tell you that my children have lived through these storms in Florida. And so even that story of where we had all these homes flood, they have memories of taking paddle boards to go help get the items out of the house, right? And then ultimately how to mitigate the losses and take out the drywall before, because there's such a backlog of assistance before assistance can come there. So it's really interesting with the solution you're putting there for the audience, but at the same time too, it just reminded me of the fact about that, again, we're talking about the impact not just of property, right, but it's to the people themselves. And just, for a moment, I just want to call your attention to the QR code that should be flashing up here in a moment or two. That's how we're going to take questions for this panel. So when it does come up, if you would go ahead and take a picture of that and go ahead and enter any questions you might have for the panel as we're up here today. So Jonathan, maybe just staying with you, there's one thing about, the village you were talking about, which is, we assume in the UK it's a village probably was long-standing, has a very long history, if you will. Here in the U.S., we have certainly, a lot of changes happened since COVID. It's migration, if you will, within the United States. And principally, we see people moving to definitely areas that have higher exposure to wind or climate or weather-related risks, if you will, and also businesses, right? And in fact, also a number of the energy transition projects, whether it be wind farms or whether it be solar panels, also tend to be in places that, in some cases, haven't been fully thought through. But as this changes, right, we talk about the 1,000-year storm. When you think about the maps that are made from a standpoint of predicting where, in fact, floods may be, as we see changes in patterns and migration and where people are now inhabiting different places that were never intended, years ago, I'm just kind of curious at what you see from your standpoint from the industry about being responsive, reactive, and being proactive about really looking for those areas and how or what tooling you might actually see being brought to bear.
Yeah, it's a really important question, and I think that one of the things that we actually see, which you just picked up on with in your example in Florida, is when you get people moving into communities and those communities start to really grow, you start to find various challenges. But one of the single biggest flood challenges that is faced is actually around drainage. It's simply, is there enough stormwater drainage capacity to handle the amount of water that is coming through? And there's a lot of communities that have still have what's called combined wastewater and stormwater drainage. So those are the most challenging ones, because unfortunately in those drainage situations, when the stormwater hits, it overwhelms, they have to release the wastewater, and that's not very pleasant, and seriously damaging in many different ways. So there's a definite challenge. I see that, and that is already there. But as I say, you start to get more and more people coming to a location where the infrastructure just can't handle things already, and never mind you then adding more population into that. There's a really big challenge on that front. I think the other thing coming back again is around education too. People. So when I actually lived in Florida for a time, I lived down in Fort Lauderdale, which I loved. And then I remember seeing the first hurricane warning and seeing people out there banging up the various boards to protect their properties, and thought, oh, that's really interesting. They're going to do that. But how many people actually, again, know what to do when they're facing one of these situations? We heard about extreme heat. That's a really challenging one again. So flood, particularly difficult, I think, because of the fact that flood tends to hit you in so many different ways. There was a comment earlier about mental health issues, and there actually has been a study done which says that you are 9 times more likely to suffer severe mental health issues for a period of 2 years or more if you were hit by flood. So yeah, when you're moving into an area where you're unaware of the risks that you face, it's definitely causing a lot more problems, which again impacts around the whole insurance side as well.
Yeah, last point on mental health, the home, I know my children have a good memory, not a good memory, that's the wrong way of putting it, but they have a memory, a clear memory of moving out of and helping those families out of. I remember their wife actually saying the fact she'd much rather suffer the house being burned down than having to live through a flood, which is a terrible testament to what they were living through. So Eric, just passing that back over to you, though, when you look at this challenge of the changing demographics. And
so I think about back to my childhood for a minute. My grandfather used to always tell me about those stories for the hardy New Englanders. He would trek through the blizzard to go to school, 5 miles and 3 feet of snow. You all remember those stories, right? So I tell my son, hey, I had to trek to school too, but maybe it was a half a mile and it was a foot of snow. Who knows? But now, where do we think today? Well, now the environment's changed. So it snows a quarter of an inch, we cancel school, or they work remote. It's great to have technology. but perhaps a lot of people and the younger people don't want to live in these hardy New England environment anymore, or the Rust Belt of the Midwest. And so what we are seeing in the United States is a migration south. And what we haven't talked about yet today, we talk about codes a lot, but we don't talk about that probably half the geography in the United States has no building codes. No building codes. Building codes are strong in the Northeast, along the coast. You know, Florida has really strong building codes. The Gulf Coast, maybe a little less. Alabama's made great progress, we know, on voluntary. But many other spots don't have building codes. So as you have more migration of our population to areas with no codes or weaker codes, guess what? Of course the losses are going to go up. And we've talked about the importance of codes. So I think that is part of the challenge we have. We also have a challenge of the population movement. South Florida, there's a lot of reasons why people are moving to Florida, right? They love the sunshine, they love the new taxes, they love the policies, I don't know. But whatever the reason is, South Florida, you think since around 2000, property values are up about $2 trillion in South Florida. So if you're an insurance company, you have to understand, we have to have a pool of money that's set aside called capital to pay our claims. As the concentration goes up, we have to actually charge within our rates a fee or recouping that return on that capital. So we'd like, as an insurance company, the spread of risk. And so as those areas are really peak exposure, insurance goes up. And so in South Florida is experiencing that right now, where insurance prices, because of a variety of reasons, are going up. But concentration is one of those also. So we just have to understand, as a country, our public policy ramifications of what we're doing. And so as we see population growth, it would be great to see corresponding codes and corresponding betterment of codes.
So I think those are great points, and I do want to touch on 2 points. One, I like to use the word adaptive planning, and I think that's something that's missing in most of our risk management in terms of the building in new areas, changing exposure, and so on. And what does adaptive planning mean? It just means that we know what we know as of today for the next few years, but at the same time, we will know better in a few years for going forward. So we really need to come to that point where that the information that we have available today is best used and updated in these local communities, and so that the planning in terms of the changing exposure can be adapted. So and that brings me to thinking that that's what happened with Superstorm Sandy. When Superstorm Sandy hit New Jersey, a huge part of the infrastructure was not resilient to that. And some may argue that that kind of infrastructure is now more resilient to the storms of the future. However, are they resilient to the storms of the future that we know as of today, or was it the information that we knew as of 2013 or 14 after the event? So, and then that's really the point. So when we talk about adequate building codes, adequate land use zone requirements, these need to be constantly updated. So there's, I mean, I agree the building codes are stronger, not strong, in over the coastline, but that needs to keep on getting updated. The other point I wanted to bring attention to is something that we, as a company, we looked into, and as an industry, we always look into blind spot risks, and blind spot risks are kind of sometimes known as Donald Rumsfeld one used to call it as known knowns, known unknowns, unknown knowns, and unknown unknowns. So this is like more of the unknown knowns, and which is the infrastructure, bringing it back to what Jonathan you talked about. And the critical infrastructure of the country is really a blind spot for us. We all know the critical infrastructure infrastructure of the dams and the levees are really in a bad situation. And so we did an analysis which we found that about 1,084 dams in the United States are critically exposed to failure with an average age of 100 years or more. So are we waiting for some other event to happen by itself? But let's also think about what if a northeast hurricane comes in and hits the New Jersey, New York area? There's 78 dams in that region that could be exposed to extreme weather. And mind it, the recent dam failures that we have experienced, whether it's the Michigan dams of 2020 or the recent dam failures in Minnesota, the Rapidan Dam, and then the Nashville Dam, all of these were critically scored high and with more than 50 years of age, and they all got failed because of extreme precipitation. And this is the change in the frequency and severity that we were talking about. And so these are risks, again, brings back to, and being emphasized by Jonathan also, about the risk assessment and communication. So we really need to bring that. So adaptive planning and really making that risk assessment and the risk information available and accessible is really going to be important.
That's great. Staying with you for a moment here, and I think it builds off of this. We have a question from the audience, and that is really about looking from a standpoint of partnership between policymakers as well as private insurers. How or are there any opportunities, if you will, to address these issues that we see before us today that could provide an immediate intervention, if you will, to help mitigate both economic and non-economic risks that we face today? So is there something that is tangible, something that's foreseeable, something we know today that said, if we were to do this in the next 1 to 3 years along those lines, is there an opportunity for us to be able to look at how policymakers can partner with insurers to really make an impact in the near term?
Yeah, I would say I think there's a lot of information, but if we focus on the near term, then the first thing that comes to my mind is public-private partnerships, right? And public-private partnerships can happen at different scale, different levels. I think the best public-private partnership that comes to my mind always, and I like to give that as an example, is the Caribbean Catastrophe Risk Insurance Facility, where multiple countries come together and put together a facility where they insure themselves from hurricane risk, and with the assumption that not every island is going to be hit every year, but at least one or two may be hit every year. So that being said, I like to bring it back to something over the Mississippi River that the industry has been focusing on. Again, the Mississippi River is really the heart of the country, which impacts the exports and a lot of the industries of the. So why can't the states come together? If the countries could come together, why can't states come together? I think there is a requirement. When we found in the 2019 floods, there were certain cities and towns that were on the Mississippi River that did not have $25,000 for emergency response. So we're really talking about towns that require a response that is immediate. So parametric solutions can be significantly beneficial to these communities. So I think that would be my view of what is the short-term solution, because ultimately resilience means all of these factors that we have talked about, building strong, and the previous panels on nature-based solutions. All these will take time. However, we also need to address the response of these communities, because the timeliness of the funds to these communities to recover has an immense impact on the resilience of these communities.
Good point. Eric, maybe you can share some thoughts you might have on this as well.
IBHS is a relatively new organization. I'm very proud that Travelers was one of the founding members of the research facility down in South Carolina. IBHS was formed after Hurricane Katrina. Let's face it, the insurance industry, we're competitors. We do not agree on everything, but the only thing that we really agreed with post-Katrina was the need for more resilience. So about 90% of the insurance industry got together and built the IBHS facility. It is 100% funded by the industry only. There's no government funds involved. We've spent $100 million, maybe even $200 million by now building that facility and running it. And so part of the mission there, as we've talked earlier, is about what do you do for future codes? What should we be doing? And there is examples out there through building codes I don't want to lose sight of. I'll get back to Alabama in a second. Alabama's one great example, but we've said code future. But the future is now in Florida. Florida has now implemented the equivalent of an IBHS fortified home in their codes, right? Just about. And so you look at that, that is a great success story. Now, IBHS did a study about what was the impact of building codes from Hurricane Charley. This is an old study going back years. And they said, well, the building codes in Florida reduced the losses by 50%. That's pretty meaningful on the amount of mitigation. So let's face it, for whatever reason, we don't have the political will to strengthen our codes everywhere. We're going to have to go slower, and we're going to have to demonstrate. And that's what I look at as the Alabama success story. What we did at Travelers, and many in the industry did, was we sponsored Habitat for Humanity to demonstrate it was possible. What we haven't talked about today is how much does it cost? So Travelers, we have been sponsoring Habitat fortified homes for almost 20 years, 15 to 20 years we've been building these with Habitat. Our experience, they're smaller houses, it was 5 to 8% additional costs, right? And some of the superintendents talked about this earlier. We could build a home to withstand a Category 1, Category 2, maybe even a weak Category 3 hurricane. We could if we chose to. So we're spending a lot of money post-events rebuilding to codes that shouldn't be there today. And so that's just an example of something. But what can consumers do? What is top of mind with me is wildfires, because that is an emerging peril that is really complex. And that is something that IBHS has leaned into it, as the commissioner said earlier, getting those standards out there. Wildfire prepared home is something consumers can do a lot of things. You can clear the brush around your house. It's very simple to do. Clear the brush around their house. For severe convective storm, for all that wind claims, consumers, look at your trees. If you have branches over your home, trim them back. Move trees away from the homes. These are the dialogues that we have to do a better job communicating to consumers to say, okay, here's the thing in your control. Here's the items you have to do if you build new. Now, let's face it. It is quite difficult to completely fortify a home to a fortified gold standard. It's more expensive if the home is already there. So we have to really start with the construction we have, new construction, and make sure we get that right, and then focus on retrofitting the roof.
Quickly add a point. I think the importance of what Eric said about risk mitigation is really important, and it's critical, because especially connecting it back to the frequency and severity, and going back to the basics of insurance. If insurance is not trading dollars, it is about its protection, or it's a financial instrument to protect against an unforeseen risk. And if we see that the exposure that we have is experiencing events that are causing losses every year or every other year, then we need to be able to mitigate that risk, right? And that does not mean removing the risk. We really need to mitigate that risk. So one more thing is there are a lot of chief resilience officers that are working on updating the infrastructure and really revisiting the land building codes and all that. I think the question for the citizens should be to also go back and ask them, what is the impact of these decisions on the insurance availability and affordability? I think that way there is clear insights about how those funds will be used towards the infrastructure which will protect these communities.
Great. Any comments, Jonathan?
Yeah, I guess listening to this, one of the things that really struck me, clearly there's the insurance dynamic, which we completely agree with both what Eric and Raghuveer said. I'm just thinking, my thought was actually going to those people who aren't insured. 40% of insurance claims fall outside of the NFIP zones, and that's a real issue. That there's that many losses that are falling outside the zones. So the challenge that was mentioned earlier in the day was how many of those communities are actually some of the most underprivileged communities, and so what are we doing to help them? And one of the things that I think is really key is to focus in on that. And coming back to Raghuveer's point about the partnership piece, in the UK we work with both Zurich Insurance and in their municipalities division, and their municipalities division actually insures a lot of social housing, and through working with them, we've now got the social housing organizations to actually engage more with the tenants, so that the tenants now can actually be able to respond and actually hopefully save some of their assets, as when a flood hits. And I think that sort of partnership is so key. The only way these communities which can't afford insurance are going to have some help is through this engagement between public-private partnerships. And definitely the Red Cross point this morning is spot on. I mean, what they were doing around fire alarms, I was just thinking to myself, wow, if they could only do that as well for flood, just go around communities helping people understand what to do, and be able to take advantage of that bit of education, because it has a huge impact, as we can see.
Just adding to that comment on the flood, what was striking to me is there's only 4.6 million people policies in NFIP today. I actually, when I pulled the number, I was surprised, 4.6 million. And it's down about 10% over the last 5 years. With all of these floods that you see on the news, and it's right in front of you. So I agree with the commissioner earlier talking about maybe there's other solutions that they have to think about, is community-based solutions. Maybe there's something else. Let's face it, the NFIP is not working today, but I have to admit the private market I don't really see as a solution because of the costs. I think we have to look at something completely different to mitigate the flood and think about the risk and protect consumers.
Some have said that maybe it should be incorporated into HO policies, but as you made note of the fact that the expense, the cost of doing that at this time is prohibitive. Maybe just letting everyone know here, there's a backlog of questions that are here. Really enjoy those that have been sent in, but we are out of time as we are being flash read here. But I really want to thank the panel for joining us here today, and also for the questions and support from the audience here. So thank you very much, and we're very close to the end of the day.
Thank you.
Thank you.
Hello again, everyone. What an incredible event this was. Thank you so much for being here. Thank you to everybody who participated. This was truly a wonderful event. This is our first in-person after years. We started this during COVID. So first in person, and I can say this was truly rewarding. And now, I've got the best job. I get to have the honor of introducing someone who is not only my boss, because she is that, but she's also been a great partner. She's been a great leader for the state. I'm talking about Lieutenant Governor Susan Bysowitz. She is currently serving her second term as Connecticut's, and it says 109th Lieutenant Governor. But those who know her and who know the state know she's been a tireless advocate for addressing the impacts of climate change on our state, the very issues that we've spent all day discussing. She has been a leader on for the state. Under her leadership, this administration has made significant strides through initiatives like the Governor's Council on Climate Change, various working groups, and the development of a comprehensive energy strategy. Their efforts are highlighted in reports such as, and this is a really catchy word, Taking Action on Climate Change and Building a More Resilient Connecticut for All. All right, they could have gotten a shorter title, but you really should read the report. It does offer us a blueprint for the future, and it reflects the commitment of the Governor and Lieutenant Governor Bysowitz to protecting our communities as we move forward. So please join me in welcoming Lieutenant Governor Susan Bysowitz for her closing remarks.
Well, good afternoon, everybody. Are you still awake? Do you want to go home? I bet. I'm Lieutenant Governor Susan Bysowitz, and I promise I'll be really brief. For those of you who live and work in Connecticut, it's nice to see all of you. And for those of you who came from outside of Connecticut, spend lots of money while you're here. I want to thank Commissioner Mays and the Insurance Department for putting on this really fantastic, forward, future-looking conference. Insuring the future is critical. This was a really important opportunity to have a conversation about the very real and present consequences of climate change and how we're working to address those issues in our state. It's an opportunity also for the private sector to talk about these challenges and how they'll affect our markets and our communities. Our state's geographic location puts it really front and center in the climate change conversation, as nearly half of our state is on the coast, and we have 618 miles of beautiful coastline in our state that also puts our state at risk. In more recent years, we've been confronted with the really stark reality that we can't afford to ignore the consequences of climate change. We've had devastating impacts in our state. And just a few weeks ago, we experienced really heavy rainfall, like 16 inches in 6 hours in some places. And the governor and I had the opportunity to go and witness entire roadways washed away in Oxford and Southbury, and businesses devastated in Seymour, and farms in Watertown, where whole crops were totally destroyed. And so we've also had, besides the rainfall, a lot of heat waves that are putting people at risk health-wise as well. By 2050, Connecticut is projected to experience stronger storms, longer, more frequent droughts, and up to 20 inches of sea level rise along the coast, and an increased flooding and frequency of flooding with levels like those that we saw in Superstorm Sandy
every 5 or 10 years, it's projected. That's the bad news, but the good news is if we work together, we can address those challenges. And that's why Governor Lamont and I have been very committed to doing what we can to make our state a cleaner and healthier place for our future generations. We need to strengthen our infrastructure and our coastal defenses to better protect our communities, and we have to guard against the rising sea levels and extreme weather events. And the good news is that our legislature has put together a coastal resiliency plan for our state, and the governor and I are going to continue to support policies and initiatives that prioritize climate resilience and fighting climate change, and we're going to continue to invest in clean air and clean water for our state and our communities. So I want to thank you all for working with the governor and I, doing this very important work. I hope you had a really great day, and it's an honor to represent Connecticut every day in our beautiful state. Thank you so much for everything that you do. Thank you, speakers, sponsors, panelists, regulators for attending, and of course, thank you to Empower for sponsoring the reception that's happening right now upstairs. See you then.